Market wanted 50, it got 50. I think the key now is, can yield stabilize?
Overall, the economy is performing like it doesn't really get impacted by kind of these swings in rates we've had the last couple of years.
The Fed's trying to get to neutral. It's just it doesn't know where neutral is.
The idea that the Fed simply through its actions brought down inflation, this is nonsense.
I do think that we are headed for a soft landing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your trading week started. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. And your scoreline looks like this. Equity futures on the S&P 500 slightly positive, up by 0.2% following closing just below all-time highs on Friday last week, but still closing out the week for a second week of gains. On the Nasdaq, we're up by 1/3%. This week is absolutely dominated by one thing: Fed speak. The list is long. I'll give you three names today, and then Lisa is going to go through the rest because it is busy. Bostic, Goolsbee, Kashkari today, but that's the appetizer for the main course throughout the week.
Yeah, although I do wonder how much we're actually going to hear. Fed Chair Jay Powell on Thursday really is the main course. We're also going to be hearing from Kugler as well as Williams and a number of other speakers. Key question to me is these are pre-prepared marks at a Treasury conference. How much is he actually going to tell us about the main question, which is how did they come to 50 after signaling 25 for so many weeks ahead of the quiet period?
Governor Waller made it simple in an interview on Friday. He said he was surprised by how low inflation came in. And I was like, inflation came in low during the quiet period, did it?
All I can say is over the weekend, a whole host of research notes came out and really highlighted the anger that a lot of people felt. Piper Sandler's Benson Durham talking about why nobody in the FOMC press conference on Monday said, "Thank you, Mr. Powell. Why did you do this? First, did you or someone else plant any story to alter market expectations? Second, if so, would such a communication strategy enhance transparency and the transmission of monetary policy, or would it damage Fed credibility?" A real feeling of anger that people are looking for explanations. Can you come out and deliberately give us a sense how much we have to watch some of these Wall Street Journal and FT articles to really give a sense of what the actual policy is?
Thank you, Bramo, for starting Monday morning with some real strength and fire. I agree with you. I wish someone would have asked a direct question like that in the press conference. I have my doubts as to whether they'd be invited to the following news conference come November 7th.
This is a key question, though, and this is not just sort of a peripheral point. We have a guest on later this show who's going to talk about the same thing. How expensive was this insurance policy? And the expense of this came with this question around Fed transmission mechanism and whether certain articles are a big piece of it. And you've heard that kind of percolate out under the surface. It's coming to the fore as people realize something is different this time.
And it muddies the water because the Fed constantly says they're data dependent. Well, now, when you're an investor, you need to be not just data dependent, but also across all news sources and deciding whether or not is this potentially a leak from Jay Powell trying to push the market towards what he was expecting or other members of the board. Paul Donovan puts it like this today. Markets want to hear that the Fed is scrambling to catch up with falling inflation, not that there's anything wrong with the economy. The other issue, of course, is not just was this just such a big insurance cut, but the politics behind this. Was this something the Fed knows that we don't know? Is the economy as bad as it is? So they need to scramble to say, actually, this is just insurance.
Well, let's get to the economic data a little bit later on this morning, some S&P global PMIs. Those PMIs already came out over in Europe, and let me tell you, they weren't good. Euro dollar, negative 0.5%, a brief break of 111. Manufacturing is terrible. Services in France, post the Olympics, let's say we're playing catch down in France and for the rest of Europe.
I thought France was actually the most interesting because we're talking about Germany, sort of the sick child of Europe, and yet France was supposed to get this big boost from the Olympics, and it faded so quickly that they're now talking about taxing wealthy individuals and businesses up the wazoo to try to raise enough revenues. This is sort of the theme that you're hearing around Europe, but also the U.S. as people grapple with the fact that they got to pay for something to stimulate the economy, and it ain't coming from nowhere because it ain't coming from the debt market.
So push this story through the debt market. The German bond market is rallying. The two-year yield doing a lot of that move, a lot of the heavy lifting, yields dropping, the curve disinverting for the first time since 2022. There is a recession knocking on the door of the ECB, and the ECB is just opening it and saying, come right in, walk straight in.
Well, this is sort of the key question. Why is the ECB not cutting much more aggressively than the Federal Reserve? We've asked this repeatedly. You say it's the dual mandate. Well, they only have to get inflation down. Inflation's been falling, and they're looking at an economy that's falling even more rapidly. Manufacturing fell to the lowest since December of 2023, and to a very low level, a recessionary type of level in Europe, how much do they respond to that? Can they justify it by saying, inflation's coming down well enough?
Even though the ECB is this single mandate central bank, had they seen this discouraging data, do you think potentially they would have at least opened the door to a cut down the line, another cut coming down the line of this timeline?
I don't think this news was surprising. I think this news is a continuation of the trend over in Europe. The data's been bad for a while. I'm not sure how much it would change things on the Governing Council, which seem to be constrained by a single mandate, which is inflation, but also things are very different across the continent. Things appear to be better in places like Italy compared to, say, places like Germany.
Some people have mentioned that.
Some people have said that a few times.
Even though we think of Germany as being the strong member of Europe, maybe it's Italy that's holding down the fort, that's actually saying, look, we can support you, but you have to support us next time around.
Germany is the problem child.
Yeah,
Euro-dollar, 111. I want to talk about two single names before we move on. I want to talk about Intel and Qualcomm. Intel up in a pre-market by close to 3%. Do they have a dance partner in Qualcomm, or is Intel going to get a dance partner in the likes of Apollo and a big cash injection, according to our reports?
This idea of a $5 billion cash injection, although it's still a lot of questions, maybe that $5 billion cash injection comes with Qualcomm. We don't know much of the details in terms of what this looks like, what the ownership structure would be, but Apollo had talked about the need to really support this. Which would regulators like better? That's my question, because, we saw Qualcomm try to have some mergers in the past that didn't really work out. Question about whether this would be more acceptable to Lina Khan if Apollo came in as the white knight.
Interesting. Qualcomm at the moment down about 0.2%. Intel up by close to 3%. Vijay, Rakesh of Mizuho, 8:15 Eastern Time. Look out for that conversation. Equities right now positive by 0.2% on the S&P. In the bond market, big rally over in Europe. Doesn't spill over to the US too much. The 10-year just about unchanged, 373.94. Coming up this hour, we'll catch up with Dan Morris of BNP Paribas on why tech will continue to lead stocks higher. Will VanLoh of Quantum Capital Group on energy investment ahead of the presidential election. And Nela Richardson of ADP ahead of a calendar full of Fed speak. We begin the hour with US stocks very close to all-time highs. Dan Morris of BNP Paribas writing, if growth is positive while policy rates have dropped 50 basis points, then the outlook for risk assets has improved. We are modestly overweight equities. We believe the superior earnings growth generated by tech companies will lead to sustained outperformance. Dan joins us now for more. Dan, let's talk about that sustained outperformance. Why are you in the camp that tech continues to outperform relative to some of the calls elsewhere about breadth improving, small caps doing nicely, financials, etc.?
Well, interestingly, it's actually at least as much a valuation argument and in favor of tech as opposed to small cap or value. So in general, earnings expectations are positive, and that's true for value, that's true for small cap, it's true for tech. The advantage right now, arguably, is that valuations, at least on a relative basis, are lower for tech than they are for U.S. small tech and value. So if you look at forward PE multiples are relatively high for value and small cap, whereas they're above average for tech, but not excessively.
Can we talk about the defensive areas of the market as well, Dan? The areas of the market that have done pretty well. The bond proxies, utilities have done nicely. Staples have had a run. Morgan Stanley's Mike Wilson out this morning turning neutral on defensives versus cyclicals. Dan, what do you make of the move in places like utilities, which have had a great run year to date? Do you think that's set to fade?
Well, if you look at it from a perspective of we're starting a cutting cycle, how have defensives and cyclicals done in the past when you had a cutting cycle? And not surprisingly, defensives have tended to outperform cyclicals, and that's fundamentally because when you've had cutting cycles, as we know, you've tended to get a hard landing, not a soft landing. Now, we've all more or less accepted that we will have a soft landing this time, so no recession. But even when you do look at the one time in the 80s when you had a cutting cycle without a recession, defensives actually still outperform cyclicals. So if we get to an environment where growth is actually slowing, and I'll point out we're not there yet, GDP for the third quarter still looks quite high, but in that environment, it would be surprising for defensives to start to turn around.
You talk about a relative basis, the better valuation. On an absolute basis, some people are getting worried, just generally, about how expensive things are. This one statistic, a model that looks at the S&P 500 earnings yields and 10-year Treasury yields, shows that cross-asset pricing is higher now than at the start of all previous 14 Fed cycles, Fed rate cutting cycles, periods that were usually associated with recession. Does that concern you?
Well, if you're looking at asset allocation from fixed income versus equities, I think it's absolutely a valid point. I mean, no one is arguing that equities are cheap. And again, if we do have earnings expectations that are relatively high, nonetheless, we at some point do see a bigger slowdown in U.S. growth. Those expectations are likely to have to come down. So it certainly is a much more balanced call than it's been at times in the past.
Okay, so at what point do you just keep leaning into your overweight in stocks, even though there is this sort of valuation argument that's challenging?
Well, I think the valuations really only seem to come into play, number one, when they're at extremes, and then you do need some type of catalyst to either increase or decrease those valuations. And at this point, we don't honestly see one. Now, we probably would have said the same thing at the beginning of July. So catalysts can come quite unexpectedly and quite quickly. But at this point, we do see momentum in terms of growth. We see momentum in terms of the earnings expectations. So we think that is going to sustain the higher valuations, even if over a medium-term, longer, multi-year horizon, you might be a bit more circumspect.
Daniel, when you say the one cycle where there was no recession in the 1980s, maybe a better reference. So what did well in the late 1980s that you're looking to now?
Well, to be honest, on a relative basis, fixed income actually still outperformed, defensive still outperformed. Where you did see a bit of a difference is that typically growth outperforms when you do get a recession, so kind of the defensiveness, if you will, of growth when you're in a negative growth environment. But in 84, actually value outperformed. So again, it's not so much to say that this is going to predict what's going to happen this time. Every time is certainly different. But only to suggest that we appreciate how this is, we hope, an unusual scenario, an unusual environment where we don't get the recession, and then to look at how that, what the implications are then for asset allocation, as opposed to just looking at what happened in the past when the Fed cut rates.
What's the biggest risk to your soft landing analysis?
Well, I think we're all focused primarily on the labor market. Now, if we look, say, again, the GDP forecast for the third quarter, it's nearly 3%, so really no slowdown to be seen there. But we all certainly recall the last non-farm payrolls data, unemployment rate in the U.S. increasing. We see relatively below average non-farm payroll gains. So, it's in a negative trajectory. That's not per se a bad thing. That has to happen. We do need lower growth if we are going to get inflation back to target. But there's always that lingering worry that it goes too far and you do get closer to zero growth, if not negative growth, than you really would like.
Well, speaking about things, data out of Europe, the euro's dropping back to about 111 this morning. Dan, how difficult is it to sell European equities to clients on the continent at the moment?
Well, if you certainly look at the difference in the growth trajectory between the U.S. and Europe, it certainly does favor the U.S., but then again, that's nothing really new. U.S. equities historically have always outperformed European equities. I think for a lot of investors, it's going to be a question of balance. How much of your allocation do you want to have in the NASDAQ or in U.S. equities? We appreciate how dominant, even in the MSCI ACWI All-Country World Index, U.S. equities are. So you want to look for some diversification, other potential sources of growth. There certainly are those opportunities within Europe. And even if we don't have as robust growth as you would like, we do still think there are potential for gains.
Dan, appreciate it. Dan Morris of BNP Paribas, and the latest out of London. If we look at Europe, you've got to start looking further upstream to the source of the slowdown. We've got to talk about China. How close is China to pulling the trigger and actually really easing and stimulating this economy?
We'll find out. Just wait. There's a press conference, or maybe they'll announce something more overnight. Here's the issue, though. You've raised this. How much are they holding back some of this for the election? And what levers can they pull? I mean, economists at Bloomberg basically saying, stimulate the housing market, put a floor under some of the declines that you've seen in housing prices. Is that really going to be long-lasting? Is that what they're looking for?
Equity futures right now up 0.2 on the S&P 500. With an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira Heckers. Hey, Yahira.
Hi, John. At least 6 people are dead in Japan after a record amount of rain triggered flooding and landslides. In western and southern Japan, evacuations were ordered for more than 100,000 people, and the government issued some of the most severe emergency warnings for heavy rain. The country's weather agency says Saturday's rainfall reached the highest daily tally for the area since the agency began recording data. Meanwhile, Ukrainian President Volodymyr Zelensky is in the United States. On Sunday, he kicked off his visit with a stop at an ammunition plant in Pennsylvania. Then later this week, he's set to address the UN General Assembly here in New York. He's also scheduled to meet with President Joe Biden to push the U.S. president to provide an official invitation for Ukraine to join NATO. He's also scheduled to meet with presidential candidates Kamala Harris and Donald Trump. And as you touched on earlier, Bloomberg has learned Apollo has offered to make a multi-billion-dollar investment in Intel. Sources say the firm has indicated it's willing to make an equity-like investment of as much as $5 billion in the chip maker. That development comes as Qualcomm is set to be floating a friendly takeover of Intel in what could be one of the biggest ever M&A deals. Sources say Qualcomm has been speaking with U.S. regulators and believes an all-American combination could allay any antitrust concerns. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, 43 days and counting.
This election is going to be close. We've always known that. That's what happens in these presidential elections. And in a state like Michigan or Pennsylvania, Wisconsin, we know that this is going to be a close race.
David Gura just around the corner, live from New York City this morning. Good morning. Equities on the S&P just a little bit firmer, up 0.1%, kicking off this Monday morning just off all-time highs on the S&P 500. Mike Wilson, Morgan Stanley this morning, writing the jobs data will be the driver of stocks into year-end. A drop in the unemployment rate, better than expected payrolls is likely the most risk-on signal for equities in 4Q. Jobs 2 Fridays away.
And this, to me, is really going to make the difference between why the Fed is cutting rates as aggressively. It all comes down to what the data says. If it's good, then do you get the sort of euphoria, the sort of candy high that people have with the soft landing that finally has been realized?
So that's the equity market. In the bond market, yields just about unchanged. The 10-year 373.75. Under surveillance this morning, 43 days and counting.
This election is going to be close. We've always known that. That's what happens in these presidential elections. And in a state like Michigan or Pennsylvania, Wisconsin, we know that this is going to be a close race. We're in it to earn the support of all Americans. And we're going to stay focused on an economy that creates opportunity for every person.
So here's the latest. Vice President Kamala Harris leading in 2 national polls from NBC and CBS. But a new poll out this morning from the New York Times giving Donald Trump a lead in the swing states of Arizona, Georgia and North Carolina. Both candidates hitting the campaign trail, with Harris in Georgia and Michigan today, and Trump speaking in Georgia tomorrow about his proposal to lower taxes for business owners. With us here in New York, Bloomberg's David Gura. David, good morning.
Good morning.
Let's talk about North Carolina.
All right.
How close is that race?
Incredibly close, as Annmarie knows. I mean, I grew up there, and there's been talk for many years now about the purpling of North Carolina. And I grew up in Chapel Hill, which has been seen as this kind of liberal oasis in a largely red state. There's been a lot of hope and prayer that other parts of the state would come in. Charlotte had promise. Will that happen? I think is a huge question. But what we've seen in the the implosion of this lieutenant governor's campaign for governor is giving Democrats a lot of good cheer going forward here into the election.
But did that travel upstream to the top of the ticket?
What's really fascinating about this state is how the ticket has been split election cycle after election cycle. I know that you got into that in your conversation with the governor last week. We've often had Republican governors and Democratic senators and vice versa. So will it travel upstream? Likely, I think likely in light of what we've seen here. I mean, I'm so struck by the way that the Democratic Party in the state has sort of said that Mark Robinson, the lieutenant governor, is the standard bearer for the Republican Party. That's what they've started to do before these recent allegations came to light. It's certainly, I think, the strategy that they're trying to engineer here is to make it seem like it's the Republican Party in North Carolina broadly. Maybe that will travel upstream.
Since you grew up there, why do they split the ticket?
It's a great question. We're talking about the Republican Party of old here as well. And so obviously Trump has made inroads. But I think that, like Massachusetts, where you have this kind of same phenomenon, there's a sense that maybe there's a merit to having some divided government, I think, in the state. Now, that's been taken to a really extreme in recent years. It's been a Republican-controlled legislature that just made the job of governing in that state hell for the Democratic governors in office. But it has been for many years. You have a Democratic governor, Republican legislature. In the past, they've been able to work together, somewhat so. Recent years, that's really kind of fallen apart.
Let's use North Carolina as a petri dish. We know that Kamala Harris has a fundraising advantage of late. We've seen that she's raised $404 million. That's what she's got in the bank versus $295 million for Trump. How is she deploying it in some of these swing states? What's the focus? How targeted is it?
So in terms of advertising, it's extraordinary. I mean, this is the largest ad spend that we've seen in TV and digital advertising of any campaign ever. Going into the election, it's hundreds of millions of dollars. And so you bring up the piece that we have out this morning by Bill Allison and looking at federal election data. And it's a huge effort to outspend both on advertising and the ground game. And I think that you talk to Republicans and Democrats, both say that this is going to be won or lost based on the strength of the ground game. And you look at sort of the integrity and the size of the Democratic ground game in North Carolina and other places, I think it's safe to say they do have an edge here. You listen to folks who work for former President Trump's campaign. They feel very confident in what they have in terms of volunteering. print advertising, TV advertising, but again, they're being eclipsed here. They're being outmatched by what the Democrats are spending right now, both from the campaign and outside groups.
At the same time, there haven't been as many kind of public forums where they can really give a discussion. We've seen Trump give a number of interviews. Kamala Harris hasn't. There's some discussion about an October 23rd debate. Kamala Harris said she has accepted it by CNN. Trump said it seems too late. What's going on here? Why is it so difficult to sort of arrange something where they can kind of be in a less scripted, or Kamala Harris in particular, sort of a more free-form forum?
I think that her campaign feels like what they're doing is working at this point. No doubt they're hearing the criticism that she's not doing more interviews. She's doing these kind of niche interviews, doing a lot of social media, getting her message out there the way that she wants to. Yes, there's a lot of kind of media criticism for not doing more. To your question about the debate, something could be scheduled. Yes, it's 43 days, but they could get together on a stage between now and then. And I think there was this kind of delicious statement from Kamala Harris's campaign chairman over the weekend saying effectively, we agreed to this. The rules are the same as the ones that President Trump agreed to before. He could do this if he wanted to. Look, coming out of that debate in Philadelphia, there's a sense from the Harris campaign that went well. The polls met that out. People reacted favorably to how she performed on that stage. They want to have it. I don't think the Trump campaign wants to, but to answer your question, fundamentally, yes, they could meet between now and then, and perhaps they will.
It's not just immediate criticism, though. When you look at the polls, there's this thirst from the voters to understand her policies a bit more. Do you think that's coming through in these set pieces she does at campaign rallies?
No, I don't think so. I mean, you look at kind of going into that debate, there was this unanswered question. Who is she? What does she stand for? What are her policies going to be? Looking at the polling after that debate, I think she answered some of those questions, but there's still more that she could do. We'll see that this week. I think both candidates are going to speak about the economy in a variety of settings, both they and their surrogates and their running mates. I think that's an effort to kind of put more meat on the bones still. But I think that there still are unanswered questions about sort of who she is. I mean, what's just to go a bit of a diversion here, looking at that NBC poll, the fact that she's being kind of seen as or billed as a change candidate is so extraordinary for me. And I think that that's something her campaign's likely to embrace. But really phenomenal here that sort of the vice president of the incumbent president is being seen as more of a change agent than Donald Trump himself.
I think we saw Governor Walz on a campaign trail over the last week saying something like, we can't have 4 more years of this. They're talking about Trump as if he's the incumbent.
Yeah, and she was able to actually paint him as such during the debate, which is why she did so well in the debate. But the issue, of course, is voters really want to know what her policy proposals are, not just the platitudes, actual details.
So help me understand this. Why is the sitting vice president so comfortable with debates, but uncomfortable with sit-down interviews with journalists asking the same questions?
That's a great question.
Can you make sense of that? My
sense of it is that she knows that because she's done so few of them, if a marquee reporter is going to go in and do it, his or her objective is going to be to get this gotcha moment.
Can I translate?
Please, go
ahead. Do you
ahead.
mean someone that actually knows how to conduct an
Fair
interview
enough.
and ask follow-up questions?
Yes, a one-on-one interview as well, which she still hasn't done, and we should say that as well. She had this CNN interview with Dana Bash, widely respected journalist, but her running mate was there with her. She has not done that kind of formal one-on-one interview with a national journalist.
You mentioned the NBC poll. If you get into that, it's working. The favourability rating has jumped 16 points since July. This is from NBC. The largest increase for any politician in NBC News polling since then President George W. Bush's standing surged after the 9/11 terrorist attacks. It's working.
But the issue is she's still falling behind Donald Trump when it comes to issues like the economy and immigration. Then when you go out and ask voters in all these swing states, what's your top concerns? It's the economy and immigration. So that is why there is this need to understand the policies more, because the top 2 issues, she's still behind Donald Trump.
So looking ahead to this week and picking up on that, I mean, if the Trump campaign is able to keep its focus this week, those are the issues on which it wants to be focusing. So J.D. Vance going to Georgia, going to Michigan as well to talk about the economy, talk about taxation. Donald Trump's supposed to be doing that later this week as well. Like, this is what his advisors have said to him from the get-go. Focus on these things. We'll see if he does it from this week forward through the election.
David, appreciate your time. As always, David Gura on the latest. Up next on this programme, we'll speak to VanLoh of Quantum Capital Group on the outlook for energy ahead of 2 very different possible administrations from New York City. This is Bloomberg. Check out Commerzbank over in Germany. The stock was down by almost 6%. Big unwind, just about unchanged on the trading day. As we report this, UniCredit raising its stake in the bank to around 21%.
My favorite part about this story is it comes about 15 minutes after Germany said it won't sell any more shares in the bank to UniCredit in Commerzbank. And we know that Germany has been really against the possible takeover by UniCredit. Then UniCredit discloses that they've increased their stake by more than 11% to 21%. So you're dealing with this sort of stealth takeover at a time where I'm not clear on why Germany opposes this, given the fact that clearly there needs to be some cross-border consolidation, according to a lot of people in the European region.
I think the Germans might prefer the consolidation being led the other way round. The German banks may be consolidating with some Italian lenders if they were the acquirer, if they were in the driving seat. Just maybe a theory that's out there on the continent at the moment.
And is the theory that it has to do with a certain feeling of superiority or inferiority, or?
Don't follow my comments. Follow the comments from the Labour representative of Commerzbank, who spoke to a French business daily a week or so ago, who said they'd prefer a tie-up with a French bank than an Italian one.
Oh, my goodness.
Basically came out and said it.
Well, here's a question. Are they going to let this go through, given the fact that they have all of the Landesbanks in Germany? And a lot of people have been saying that in order for them to remain strong and be able to withstand any kind of downturn, potentially led by manufacturing, they're going to need to consolidate.
UniCredit raising that stake in Commerzbank to around 21%. The latest news out of Europe. The latest news stateside, equity futures on the S&P 500 firmer by 0.2%, up 0.25% on the Nasdaq. On the Russell, the small caps up by 1/3. A second week of gains on the S&P 500, closing just south of all-time highs on Friday's session. If you switch at the board and turn the page to the bond market, let's look at a yield curve and settle on the front end of the curve. The 2-year 356.55. Last week, the 2-year not even up a single basis point. Completely dead flat, muted price action at the front end of the yield curve following that 50 basis point cut from the Federal Reserve.
Yeah, buy the rumor and not even sell the news, I guess. But this really is sort of the key question. Have we baked in the full effect, the full ramifications of the 50 basis point rate cut? And we're going to be talking about that throughout the day, this sort of question of what did the Fed earn by making this move that actually did surprise the market in terms of how opaque the communication was leading up to it.
Nela Richardson of ADP joining us in 15 minutes' time. I want to talk about the euro. The data out of Europe, not great at all. A series of downside surprises across the PMIs. A break of 111, a brief break of 111 on euro dollar. We settled down at about 111.13 at the moment. Bad PMIs opening the door, seemingly, you'd think, to a real conversation about deeper cuts at the ECB.
And if you don't get deeper cuts at a certain point, do you get ongoing euro weakness, just simply because there is going to be this ongoing weakness in the overall economy? Just a real question how much this really does have to do with rate differentials and whether we can really price them out according to some of the rhetoric, which has been ambiguous.
The 2-year in Germany down 7 basis points. Big rally in the German bond market this morning. Under surveillance this morning, authorities in China announcing plans for a rare briefing on the economy. The news boosting hopes for added stimulus after the country's central bank cut one of its short-term policy rates. China's economy now facing its longest streak of deflation since 1999.
And a lot of this has to do with the fact that people's housing prices have gone down so much and they aren't able to send them, and it was a store of wealth, that where are they going to get the confidence to keep spending? This is one of the reasons why you've seen deflation to such a degree. A lot of people speculating that the Chinese authorities are going to have to support housing prices, but this kind of gets them back into the same cycle that they're trying to avoid, which is an over-leveraged sector and an unreliable economy that doesn't have the engine that it was looking for.
This comes down to the fiscal fire hose that Goldman Sachs, Jonathan, you mentioned a number of times. Potentially, you have Beijing waiting on the sidelines till November 5th. They want to see who wins the U.S. election, decide whether or not they are going to use that fiscal power, because they might have to use more of it if there's one candidate, and that's the former president, Donald Trump.
It's certainly the economy that needs some support right now. Let's turn to this story, the latest out of the Middle East. Israel ramping up attacks against Hezbollah in southern Lebanon and urging civilians to move out of the area. The increase in exchanges fueling concerns of an all-out war. The increased response coming after a series of pager and walkie-talkie explosions across Lebanon in the past week.
This already is all-out war. I mean, you can call it whatever you want, but there are incredible numbers of missiles being lobbed over, and it might be unconventional warfare, and people are going to study it and figure out what the modern warfare actually is going to be with supply chains and the like. Question now is, what does escalation look like? How rigid are the different sides and entrenched in what they would like? And it doesn't seem like there's an easy coming together kind of moment, despite some of what we've heard from John Kirby over the weekend.
Yes, how do you put the genie back in the bottle. This already feels like almost an all-out war between Hezbollah and Israel, as they still are also dealing with what's going on in Gaza. President Biden over the weekend telling reporters that we're going to do everything we can to keep a wider war from breaking out. Well, they sent Amos Hochstein there the past couple of days. We heard from Admiral Kirby over the weekend. He's basically saying that a ceasefire in Gaza at this moment is on standstill, even though there's a lot of efforts there. All of these efforts, all of these phone calls, but still, the tension continues to ratchet higher.
Let's turn to the nation's capital. The latest out of Congress. Congressional leaders unveiling a stopgap funding bill yesterday in a bid to delay a government shutdown until December 20th. The bill would keep existing funding levels while boosting money to the Secret Service. The House is expected to vote on the measure as soon as Wednesday, ahead of the September 30th deadline.
So we heard from Speaker Johnson over the weekend. While this is not the solution any of us prefer, talking to his colleagues, it's the most prudent path forward under the present circumstances. What are the present circumstances? All of these individuals want to get back to their districts, want to get back to their states because they have an election to win. So they're basically saying we're going to keep the government open, but only till December 20th. So we're going to do this all over again right before Christmas.
All I know is we don't have to talk about it until December, so let's move on.
Is that what you're hoping?
Yes. Well, I mean, isn't this going to get passed now? It doesn't have anything that's
we all hope
substantial.
we can move on from this, and then we'll see you again in December.
Okay.
That's what we're all hoping for, yeah. Let's get to the latest elsewhere. Donald Trump and Kamala Harris looking to pitch their visions of the U.S. economy at dueling events this week. U.S. energy policy a key issue, including the price of oil and gas. Will VanLoh of Quantum Capital Group joins us now. Quantum is an active private equity firm in the energy space. Will, good to see you. Good morning.
Good to see you. Thank you.
Help me understand this. I want to understand your reaction. When you hear these candidates on the campaign trail say, we're going to boost energy output in this country, we're going to halve prices are going to come down. How do you react to that?
Well, I don't think we're going to be able to drop prices a lot. There's oil and gas prices are set as a function of supply and demand. And so, you know, when you talk about halving prices, you'd have to massively increase production. And I don't think the U.S. can really do that.
Is that because break-even prices are so high and ultimately if we do that, production's going to come off again? Is that because of the discipline we now see of some of the producers, because investors have basically got them on a very short leash over the last few years? What is it?
I think it's a little of everything. Clearly, the investors have put oil and gas companies on a very short leash, and they've required a massive amount of the cash flow every year to get returned to shareholders through buybacks and dividends. So that alone is going to be a bit of a dampening on being able to increase production. But the other issue really is the U.S. shale revolution has run its course, and you know we've tripled oil production in the last 15 years, and we have doubled natural gas production. That's an extraordinary feat, right? We're now the largest oil producer and largest gas producer in the world. We produce more than Saudi and Russia combined. So there's not a lot of gas left in the tank, I guess I would say, to be able to do that.
The former president continuously talks about how he wants to drill, baby, drill. He's going to unleash all of this. To John's point, what is the break-even point? Because if you're going to open up the taps, even though this is a free market, so we don't have a state oil company that can actually do that, but what is the break-even point for shale to remain profitable?
It's different. So every basin has a different break-even point. Every part of every basin has a different break-even point. But from our analysis at Quantum, we would say that for something below, say, $60, you know, we don't have a long runway of inventory left.
And this is basically why in April of 2020, the former president actually had to come out and call Putin and Mohammed bin Salman so he can get prices higher, something U.S. presidents don't normally do. I want to also ask you about LNG. Mm-hmm. How difficult has it been with the Biden administration in terms of LNG permitting?
Well, as you know, the Biden administration did put a halt on all new LNG permits a number of months ago. And I think that was really a big mistake because many countries around the world are starting to rely on U.S. natural gas for their energy, especially after what happened in Russia and Europe last year or 2 years ago. And so that it's a big issue. It's very hard. These are all multi-billion-dollar projects. It's very hard for investors to plan ahead with that kind of political uncertainty, you know, to commit to projects that are $5, $10, $20 billion projects each. So it's put a big challenge on the U.S. LNG sector. A lot of Qatar is getting a lot of the benefit of that, and other countries around the world are getting the benefit of this stay on U.S. LNG.
Can we just sit on that for a second? You are an investor with a lot of money to put to work. How are you handling that? The idea that permitting is being put off, given that you see a real opportunity for the U.S. to take up some of the market share there. Are you continuing to invest? Have you actually held off on specific investments?
Well, we invest across the whole energy value chain. So we do oil and gas, we do midstream, we do wind, solar, We do LNG. We actually do have an LNG project on the west coast of Mexico that has gotten held up because of this LNG stay. So for us, it's when things like that happen, we kind of shift capital around, but we're always investing. There's lots of different parts of the value chain that's not being affected by.
Given the fact that there is this policy uncertainty, I'm curious about specific aspects of the energy field. You talk about renewables. And right now, we keep talking every day about supply chain disruptions, supply chain security. We talk about the fact that, especially when you have imported goods from overseas, it could be tampered with. How much is that really in the forefront for the United States, given how much of the renewable energy supply chain comes from China?
Yeah, I think that's, energy security became very in focus for everybody 2 years ago, right? Whenever Russia went into Ukraine, given what happened in Europe. And when you look at China and how much of the energy supply chain they control, the value chain they control for renewables, it starts with minerals. So first of all, you got to mine all these minerals, right? Copper and lithium and cobalt and zinc and all these minerals. China controls, depending on the mineral, anywhere from maybe 5 or 10% to as much as 60 or 70%. But the raw mineral does nothing for you. You have to refine it, you have to process it. China 20 years ago started building out massive amounts of processing and refining capacity for these minerals. So they control 40 to 80% of the processing. And then when it comes to actual manufacturing, China makes 60% of the world's wind turbines, 75% of the world's solar panels, and 85% of the world's lithium-ion batteries. So you think about China's control over the green or the renewable energy value chain is massively greater than OPEC's ever was over oil. And it's one country. It's not 12 or 13 countries trying to act together. It's one country. So that should concern everybody.
So we've replaced our reliance on OPEC with a reliance on China.
Yeah.
Do you think that makes us more vulnerable and not less?
Absolutely it does. Now, the good news is the U.S. today is energy independent. The shale revolution did that. We were the largest importer of energy 20 years ago. Today, we're one of the largest exporters, and we're fully self-sufficient. But as we move more and more to the green energy economy, we can't make all this stuff in the United States. The West can't make all this stuff. And
so that's a challenge. Is it harder to invest in? Lisa's point about supply chains, just for you, is it difficult to get visibility on a full supply chain, to have an understanding where there was forced labor and where there wasn't in a place like China?
Very tough. We had a number of our solar projects in the U.S. over the last couple of years basically just stopped dead in their tracks because we could not get the panels in.
When you look at China and you're talking about this absolute control they have and domination when it comes to raw materials and the processing, is this a long-term play? Do they want to be the Detroit of the world?
Yes.
In the yesteryears?
They absolutely. They've got 4 or 5 massive kind of national initiatives, and that's one of them. Dominating the energy transition value chain is paramount because they don't have very much oil. All they have there is coal, and that's one reason you see China electrifying everything. Is not because they're necessarily trying to do good for the environment, but they have a lot of coal and they import. They're the world's largest importer of oil. So they are absolutely going to continue to try to dominate that space.
As an investor, are there specific areas that you could invest in domestically or outside of China that could offset some of this reliance?
It's challenging, right? And it's not a matter of, yes, U.S. investors can invest in China to get exposure to it, but many of those are state-owned enterprises. But there's companies in Europe, there's companies in the U.S. that you could invest in that do have exposure to different components of that value chain.
How difficult is it, given the fact that foreign policy sometimes gets in the way? I know that there's been a big debate over Congo, for example, as a place, and then there's a lot of issues about exactly the humanitarian issues about the U.S. going in. Right. Are you involved with any of those discussions?
So I think, and this is the interesting thing, ESG has driven this in climate has driven this push into the energy transition. But I think people are very blind to the fact that, where most of these materials come from, the social and governance issues are really bad, right? And the mining itself is really bad for the environment. And so there's trade-offs to everything, and there's no free lunch. And I think people, as more and more people become aware of that, it's going to be more and more challenging, especially for U.S. companies, to go into these countries that where the minerals actually and the metals exist, because we've got laws that prevent us from doing business in ways that other countries aren't prevented from doing business. So it's going to be very challenging, I think.
Do you think we've seen the peak of ESG virtue signaling? Do you think that's done? Have we had the wake-up call, the reality check?
I think we've seen, I would say what we have seen we raise most of our capital from very large institutions across the globe, okay? And what I would say is outside of Europe, So investors in the U.S. and other parts of the world, I think, have become much more pragmatic about ESG. At the same time, there's still a very strong push with climate to meaningfully green up our energy supply. So I don't at all think it's going away. I think it's going to continue to go forward. But I think people are going to start looking at all aspects and realize that, green energy is not so green.
Well, this was fantastic. Appreciate your time. Come back soon because we need to talk about the energy demand from data centers as well and some of the off-grid solutions that are coming up there. Will VanLoh of Quantum Capital, thank you, sir. Appreciate it. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahira Hackers. Hey, Yahira.
Hi, John. The House has unveiled a short-term stopgap funding bill to avert a partial government shutdown. House Speaker Mike Johnson laid out the plan in a letter to colleagues yesterday, just 8 days before funding runs out on September 30th. The bill would direct more money to the Secret Service after a second assassination attempt on former President Donald Trump. Lawmakers aim to vote on the measure by Wednesday. Meanwhile, Elon Musk's social media platform X has backed down and agreed to comply with court orders in Brazil. A judicial filing shows that X has finally appointed a legal representative as required. Sources also say it's blocked accounts accused of disseminating hate speech and fake news. It could end a months-long clash that resulted in million-dollar fines and a ban on the platform. And Donald Trump delivered a campaign speech in North Carolina this weekend where he attacked rival Kamala Harris and detailed his campaign pledges. What he didn't do was mention the controversial Republican nominee for governor, Mark Robinson, who he previously endorsed. Our own Annmarie was in North Carolina on Friday and spoke to Governor Roy Cooper about the election.
We're a very purple state. We're always going to be close. But I'll tell you this, Donald Trump has to win North Carolina in order to be president. If Kamala Harris can win this race here, and we believe she can, she's the next president of the United States.
Cooper also mentioned that Trump hasn't said anything negative about Robinson. That's your Bloomberg Brief. John?
Yahira, thank you. AMH, fantastic work. Big takeaway from last week. What was it?
It was that North Carolina is getting a lot more interesting when it comes to Lieutenant Governor, who's the Republican gubernatorial race. Donald Trump notably didn't mention him on Saturday, even though in the past he talked about him and really wanted to ingratiate himself with him. Now there's a lot of distance there.
Things are super close in that state. Up next on the program, sizing up the U.S. consumer.
We think the consumer is actually really well set up here. They've got household balance sheets in really good shape. We think inflation's settling now in a 2.53% range. Fed seems okay with that here, but that's kind of a no landing outlook.
Nela Richardson of ADP, up next. We are just about positive this morning. Good morning to you all. Up by 0.2% on the S&P 500. In the bond market, yields going nowhere. The 10-year 374.32. Under surveillance this morning, sizing up the U.S. consumer.
We think the consumer is actually really well set up here. They've got household balance sheets in really good shape. We think inflation's settling now in a 2.53% range. Fed seems okay with that here, but that's kind of a no landing outlook. The economy's performing like it doesn't really get impacted by kind of these swings in rates we've had the last couple of years.
So here's the latest. Markets awaiting fresh data this week, including consumer confidence on Tuesday, another round of jobless claims on Thursday, and PCE on Friday. Nela Richardson of ADP saying that Friday's inflation print will be the most important, writing this: PCE for August will validate or not the Fed's outsized rate cut and could set the tone for cuts to come. Nela joins us now for more. Nela, good morning.
Hi, good morning.
Do you think it will validate that 50 we got last week?
You know, I think so. It looks like inflation is coming down. What won't likely validate the Fed's 50 basis point cut will be how good the consumer continues to do. And so back to the lead into this, the consumer's in great shape. So as long as inflation is going down, then the Fed can be aggressive on the rate. If either of those two things change, we have to kind of rethink the strategy today.
Does this go back to this question of how effective were Fed rate hikes to really bring down inflation, and how effective will they be to stimulate borrowing, considering that borrowing is already pretty high among the average consumer.
Not only is borrowing high, borrowing relative to debt and disposable income is actually pretty low. So this is a very different situation than what we saw coming out of the Great Recession, where, financing costs relative to income was really super high, above historical norms. Now we're below historical norms. So that marginal increase, that boost in getting more debt, more borrowing just by bringing interest rates down is not going to translate in the same way with the same impact in today's economy.
There's a fear right now of the boogeyman, and that is going to come in the form of jobs report that comes in weaker than expected, because right now people are just embracing the soft landing and hinging all bets on that. Is there anything that you're seeing under the hood? Because ADP has actually been almost more prescient than some of the other indicators with respect to the jobs market over the past couple of cycles. Is there anything that you're seeing that really edifies these concerns?
No. I mean, when you look at the jobs market broadly, you still see hiring. And the hiring that we're seeing now is actually healthier hiring, because it's not just replacing workers who are leaving. Turnover is quite low. So when you see hiring today, it's because companies are actually trying to grow their head count, not replace workers. There are pockets of weakness, and that's concerning, especially when you look at manufacturing. So here's where rates might make a difference. Manufacturing is a very cyclical sector, and so an interest rate cut might boost some investment, which could lead to more hiring, but this is going to play out over a long period of time. You're not going to see it right away. The first place you're going to see it is probably in the borrowing rates of small businesses, mom and pops, and consumers. It's not going to translate into the overall labor market picture until much later in the cycle.
I want to ask you about something you write in your latest report, a job or joy. Many young workers would rather be unemployed than unhappy. What is going on with Gen Z?
Well, first of all, they're young, and so they have the ability to make that choice. But yes, when we survey workers, we ask them, would you rather be unemployed or unhappy? Gen Z is much more likely to say that they'd rather be unemployed than unhappy. Happiness is really important to this generation. And you know what? They spent 2 years of what should have been a happy period bolted down by a pandemic. So I'm not going to judge them too much.
I'm not going to profess that money means happiness, but you have to have money in order to sustain a life. What are they doing for work? Will they quit their jobs if they're seriously unhappy?
No, they'll just complain about them. We haven't seen a widespread turnover. You're laughing, but it's true. We haven't seen a widespread. Yeah. The idea here is that Gen Z, many of them are coming into a workplace that's very, very different than the ones we entered. There's not the mentorship. There's not the engagement. People are working remotely. Sometimes their bosses are in another location, in another metro area. That is much more common than when Gen Xers or millennials actually went into the workforce. So why go into the office? And that leads to some dissatisfaction in terms of their work as well, I think.
This conversation makes me feel really old. A group of people getting around being like, kids these days, they don't have any work ethic. I mean, how much is this sort of what happens every generation? They don't know what real work is versus something actually different.
The difference is we can measure it. So we know
just how ineffective they are.
Exactly. Okay. And then we can talk about it. But it really does present an opportunity to companies. If you know that young people are in this state, that they're making this choice, that they'd rather be happy and unemployed than unhappy and employed, then it really does give you an opportunity to reach out, to engage, to make sure that they're being productive. Because what you don't want them to do, like them leaving is not the worst thing that could happen. Them staying and not being productive is bad for your business. So how do you engage young people in the workplace? That's what we're trying to help them see.
I think we all agree on that last point. Nela, thank you. Nela Richardson of ADP, a Bloomberg TV contributor on the latest in this jobs market. Bramo, I know you've got a lot of thoughts on this story.
Well, on one hand, I've heard a lot of people say work ethic of this generation, it really leaves something to be desired. I actually have a pet theory that the smartphone has been so distractible and it created such a distraction
you
that I think
the iPhone.
I do. I blame smartphones, and I blame sort of the lack of, the immediate sort of self-referential stimulation changes the scene. But then I feel really old. It's like, those kids.
This is why a lot of state legislatures are banning them in high schools, because kids just do not pay attention when they're supposed to be learning.
You see this in every generation. The difference here is corporate America panders to it now in a way that I don't think they ever have done.
Bingo.
Okay, really? You're saying that they're just, you need to tighten up, kids? I don't know.
No, I think those days are over. I don't think they get that message at all. Up next on the programme, Yardeni of Yardeni Research, Jason Furman of the Harvard Kennedy School, Aron Levine of Bank of America, and Erik Nelson of Wells Fargo. From New York, this is Bloomberg.
For equity markets, this is a seasonally weak period.
Tech, the last couple months, has really begun to cede some of its strangle on the leadership.
We should be buying volatility, we should be defensive, and we should expect more surprises.
Hopefully we're in a brief period where okay news is actually good for the markets.
This Q3 earnings reporting period will be very important and pivotal to where the market goes from here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now with equity futures on the S&P 500 up 0.1%. On the Nasdaq 100, the gains resume up 0.2%. On a small caps, the Russell up 1/3%. The week ahead, a sprinkle of economic data and a ton of Fed speak. Kicks off with Bostic and Goolsby and Kashkari a little bit later.
Yeah, and later on this week, on Thursday, let's get drumbeat. Powell, Collins, Kugler, Williams, Barr, and Kashkari all coming out, albeit the key marquee speaker, Jerome Powell, will be in pre-recorded comments, so don't get too excited. At the same time, there's this question about whether we get more insight in how contentious this decision was that led the Fed to cut rates by 50 basis points after a widely expected cut of 25 basis points by economists looking at the data.
The focus has shifted from inflation to the labor market in a big way. Neil Kashkari of the Minneapolis Federal Reserve, some headlines on him at the moment, saying Federal Reserve policy is still tight after a half-point cut. There's still some space here to cut even more.
He has been in the more dovish camp, saying the risks now tilted to a weakening labor market. Cue the labor market report that we get in a couple weeks' time. How much that's really going to inform how much further the Fed can cut. Question is he in the mainstream or is he on the fringes at a time where Mickey Bowman is also going to speak? And maybe she'll give some insight in just how vulnerable she sees the economy to being tilted the other way, where inflation becomes more of a concern again.
Stuart Kaiser over the weekend saying the September event obstacle course did not offer true clarity on growth, which is why it's going to be so interesting what these Fed speakers have to say. He said the election or Fed policy, still a lot of question marks. As a result, event risk gets rolled forward another month with payrolls the belle of the ball. How important is that payrolls data going to be?
The only important thing this week is the traffic in New York City, so we should probably get a traffic report from Bramo on that front. Midtown traffic is just a mess at this time of year.
Okay. According to the Department of Transportation.
You've got stats. Let's go.
Traffic data shows that average motor speeds in Midtown are the slowest of the year during UNGA, the United and
Do they have a four handle? Are we talking 4 miles an hour, something like that?
No, actually, it's below that. It's
the
average. Traffic speeds dropped to 3 miles per hour on average. There were days it was also closer to 0 miles per hour. Basically,
that's walking speed.
That is not speed. That is standstill. That
Take
is
the metro.
Literally gridlock.
Take the metro.
So, yeah, you don't. That was according to.
Take the metro. Move the UN. Move it to Queens.
Queens. People are right in.
Take it down.
Hold on. When was the last time you went to Queens?
Queens
all the time to get to the airport.
No, you went to Queens to
go. Queens all the
you
time.
went to Queens to go to the U.S. Open, and how was the traffic then?
It wouldn't be me in the traffic, would it? It would be heads of state getting stuck in the traffic in Queens.
Okay. Can I just say we welcome all of the leaders. We're very excited to hear how this transpires. Just avoid. We
welcome all the leaders. We're willing to give us interviews.
I don't know anyone who lives in New York who's like, we welcome all the leaders to New York City.
We leave. I mean, it's just basically.
We welcome those that give us interviews.
All I know is I welcome an interview with Sam Schwartz, also known as Gridlock Sam. Please come on.
Gridlock Sam.
Yeah.
Is that where those stats are from?
Yeah.
That's awesome. 3 miles an hour, average speed.
Or 0.
That is brutal.
That's not moving.
Let's get to the price action. Equity futures on the S&P 500 shaping up as follows. We look a little something like this. Slightly positive throughout this morning on both the S&P and the Nasdaq. We're up by 0.1%. Yields are a little bit higher by almost a single basis point, 374.89 on a 10-year. Coming up this hour, we'll catch up with Yardeni of Yardeni Research on why the Fed is risking its credibility. We'll speak to Jason Furman of the Harvard Kennedy School on why he thinks Harris is the safer economic choice, and Erik Nelson of Wells Fargo on his bullish dollar call, which becomes a little bit more interesting given the data, Lisa, we saw out of Europe earlier this morning.
Yeah, ultimately, how much you get a prospect of dollar strength just because everything else is so weak. And we've been talking about this a lot. The idea that the Fed could still cut quite considerably and you still get a stronger dollar because, hey, what's going on over in Europe? Whoa, just kidding. All of a sudden, manufacturing goes the lowest going back to December 2023. Either the ECB cuts or growth falls off a cliff. Either way, it's not particularly positive for the euro.
It's not euro bullish, that's for sure. 111.16 on euro dollar. We begin the hour with stocks mixed as markets await a slew of Fed speak this week following this month's landmark Fed decision. Ed Yardeni of Yardeni Research suggesting the move wasn't needed. The Fed is starting a new easing cycle to avoid a recession that we don't see coming. The Fed is risking its credibility by easing without regard for election results, as both presidential candidates' policies would raise the federal deficit in a one-party sweep, an inflationary prospect. Ed Yardeni joins us for more. So, Ed, before we get into the election, if they've cut interest rates by 50 basis points when we don't need it, isn't that just overwhelmingly bullish on this equity market?
Absolutely. Yeah, I mean, I raised the odds of a just outright melt-up like something we had in the 1990s. I've been talking about it only a 20% probability, and I'm raising that to 30%. And then I still have 50% in what I call the roaring 2020s. So that's 80% that we're in a bull market. The 20% I kind of leave for a 1970 scenario as a result of geopolitical risk.
So are you saying that that 20% is going up in terms of the potential for inflation to roar back as a result of the Fed's move?
Well, again, these are my own subjective probabilities, and I went from 20% to 30% on a melt-up, and lowered the roaring 2020s, which is also very bullish, from 60% to 50%. So that, again, it still adds up to 80% that we're in a bull market. I think by cutting rates by 50 basis points and by indicating that they want to do more, at least in some of the recent comments, they're risking overheating a warm economy. The economy is doing quite well. We've seen initial unemployment claims coming right back down. I think we're going to have a really strong personal income number and consumption number. So I think real GDP is going to be, again, probably 3% in the third quarter, following the same kind of number in the second quarter. So if they overheat the economy and create a bubble in the stock market, they're creating some issues. But as you got me in my quote, I'm concerned that they're just completely ignoring what's right ahead of us here, which is a presidential election, and either candidate's policies are likely to be inflationary and bloating the deficit again.
So you think that that's potentially the biggest risk right now, or one of the biggest risks to valuations? And just to give this as a historical standard, and this from Michael Purvis over at Talbot and Capital, that back in 1995, the last time we got this kind of soft landing, the forward PE on the S&P 500 was about 13.5%. Currently, it's about 22 times. So we're starting from a pretty high valuation. So getting to that potential election risk, can you just play that out, what that looks like?
Well, look, we're not in 1995. I think we're more like in 1999 based on valuation multiples. We certainly have the Buffett ratio, which is the total market cap to GDP at basically a record high. We have the forward PE around 22, as you said, and back in the tech bubble, it got up to 25. So we're already in the 1999 kind of territory. And here comes an election where fiscal policy could once again turn out to be inflationary and bloat the deficit. And the monetary policy is acting as though the Fed is acting as though monetary policy is the only thing that matters.
Ed, last time you were on, though, you said that you think we're going to reach new all-time highs on the S&P 500 because there's going to be gridlock in Washington. But what if there's not? Which party sweep hurts the S&P 500 more?
Yeah, well, I have been indicating that the election matters a great deal, and if we don't if gridlock doesn't win, then I'm going to have to reassess my view on where we go from there. Right now, I'm still betting, as I think the markets are betting, that gridlock will win, that the Senate maybe will go Republican. I guess the latest polls are showing that Harris is moving ahead of Trump. But who knows? We'll see how it all plays out. But I'm not going to, I may just have to change my views depending on how the election plays out if gridlock doesn't win.
No, but I guess what I'm trying to get from you is how do you foresee markets reacting to a blue sweep versus a red sweep?
I don't know that it's going to make that much of a difference. I think it's bad either way. A sweep our constitutional system was designed by lawyers, and lawyers designed it so that more often than not, it wouldn't work. The idea being gridlock, of course, being checks and balances. And it's worked quite well over the years. If we just get a complete and total sweep by the Democrats or Republicans, I think both of them are promoting some pretty radical fiscal policies that would not be good for the market because it would probably be inflationary.
Yeah, the longer that they have rallies, we have no taxes. I am curious about going forward, what you're buying, given some of these concerns.
Well, look, I think up ahead here, if we get a sweep of one or the other, the deficits will bloat. We already have interest expense at an all-time record high, and that's not going to come down. That's going to continue to go up. I mean, I guess you could argue that maybe one of the reasons for lowering interest rates on the part of the Fed is to take the pressure off on net interest expense. But why enable fiscal policy to continue to run excessively hot? So that's where we have to look at both fiscal and monetary policy, whereas Fed officials are just focusing on what their policy is going to do to the economy without really putting it in the context of the overall economy, the overall policy making out of Washington.
Just to put a bow on it, do you actually think there's a real risk of an interest rate hike in 2025?
I don't know. At this point, I wouldn't say so, but ask me again after the elections. Look, I'm still in the roaring 2020s camp. I'm still optimistic that productivity is really the key variable that's going to continue to work. Unit labor costs in the second quarter fell to 0.3%. That's why inflation's come down. Productivity is the big hero here and why inflation's come down. I mean, the Fed's trying to take a lot of credit because they tightened and they concluded that their mission has been accomplished when they lowered the Fed funds rate by 50 basis points. But the real key to inflation coming down has been productivity, and I think that's going to continue to be the case. Look, the reality is, if the Fed's overdoing it here, we're going to get stronger growth, and if productivity can accommodate that, then inflation will stay down, and the stock market remains in a bull market through the end of the decade, which is my base case at this point.
You know what's your scariest part of the 2020s? Cool, we're halfway through the decade. Isn't that nuts?
Well,
Isn't that
nuts?
Yeah,
we're not. We're going to have to wait until, 2029 to really recognize the roaring 20s? I don't know. I don't feel like we're there.
Ed Yardeni of Yardeni Research. Ed, we've got to leave it there. Thank you. I remember when Ed made that call. Doesn't feel like that long ago. And now we're halfway through the decade.
I know. Please, you're making
Time's
me feel...
flying.
I mean, first of all, we start saying, the kids, and now it's like we're halfway through the decade.
Let's
what
talk
is
about
this?
The 2030s.
Oh, my goodness. Let's
I'm
move
pleased
on.
that Ed Yardeni went there because Adam Posen of the Peterson Institute is talking about this a lot. The prospect of hikes in 2025, highly dependent on the outcome of what happens November 5th.
Ed seems to be just ignoring, though, that idea of this sweep and wants to talk gridlock into reality because that'll be the best situation for markets. But the issue is the Fed right now is not taking the potential fiscal policy of 2025 into an account. And if they were, and potentially if it's the former president, Donald Trump, and there's tariffs, does that mean they actually would have to hike because those are inflationary?
We have no idea what anyone's policies are going to be. And we could talk about the fact that Kamala Harris hasn't done any interviews. Donald Trump has done a lot of interviews and promised a lot of things. And people are like, this one's possible, this one's not possible. They sort of cherry pick the ones that they like. We have no clue. So let's wait till they get into office, whoever it is. Let's wait till the congressional makeup, whatever it is. And then let's figure out what actually gets done, whatever happens. And then we can talk.
But just a moment on that. On Saturday, he was taking a beat from Bernie Sanders, basically becoming a Bernie bro, talking about how he wants to cap the interest rates on credit cards. Bernie Sanders has been calling for that cap for a while at 15%. And former president doubled down again over the weekend, saying it should be at 10%. Again, the Oprah Winfrey election. They're throwing spaghetti at the walls, populist ideas to get out the vote in these swing states.
To Lisa's point, by the end of the month, there will be no taxes in the United States of America.
Yeah,
We're that close.
Right. So, do we just sort of say, oi the deficit, or do we say none of it's actually going to get passed? So it's sort of this tricky thing that I see in all of the analyst reports, like, do you take this at the word? Do you know this? And you could make the argument, well, Kamala Harris hasn't done any interviews, but you can make the other argument, we've gotten a lot of information, and none of it really is kind of
It's not an argument,
truth.
it's just a fact.
It's just a fact, yes. But my point being that I'm looking at this and I'm just thinking, what information are we actually getting on either side right now that's going to stick with any kind of promise?
Which is why we should settle it with a debate on CNN at the end of October. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. TSMC and Samsung have reportedly discussed building new factories in the UAE to help satisfy soaring demand for AI computing. The Wall Street Journal is reporting executives from the chip makers have visited the UAE recently to discuss major new operations. The Middle Eastern nation is aiming to become a regional hub and testing ground for AI. And Bloomberg's reporting UniCredit raised its stake in Commerzbank to 21% just days after the German government indicated it opposes a takeover of the lender. UniCredit entered into financial instruments relating to an additional 11.5% stake in Commerzbank, according to a filing by the Italian bank, which already owns about 9% of its German rival. And Vice President Harris outraised and outspent Donald Trump in August, according to new filings from the Federal Election Committee. The Harris campaign raised more than $189 million in August, more than quadruple the $44 million that the Trump campaign brought in. Though the Harris campaign also far outspent Trump in August, the vice president ended the month with $404 million in cash on hand, dwarfing Trump's $295 million war chest. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes. Up next on the program, competing visions for the U.S. economy.
I had the greatest economy in the history of our country. I think in the history of the world. There's never been such production that we had. And I'll be able to do it again, and I think very quickly.
Jason Furman, up next. Live from New York City, your equity market a little bit firmer, up 0.1% on the S&P 500. In the bond market, things pretty stable. Yields are higher by almost a basis point, the 10-year 374.89. Under surveillance this morning, competing visions for the U.S. economy.
I had the greatest economy in the history of our country. I think in the history of the world. There's never been such production that we had. And I'll be able to do it again, and I think very quickly. We were energy independent just a short while ago. We'll be energy independent, but we'll actually be energy dominant again. And we're going to make a lot of money. We're going to pay off debt. We're going to pay down debt. And we're going to do things that nobody would have thought possible.
So here's the latest. Donald Trump and Kamala Harris planning dueling economic addresses. Trump speaking at Georgia tomorrow, offering his plan to lower taxes for business owners. And Harris saying she'll deliver a speech this week outlining her economic vision. We get lucky this morning. We're joined by Jason Furman, the professor at the Harvard Kennedy School and former chair of the Council of Economic Advisors under President Barack Obama. Jason, welcome back to the program, sir. It's been far too long. Before we get to the election race, let's just talk about the state of the economy. So a lot of people are still talking about whether we can achieve a soft landing. Do you think it has been achieved already?
I think we're close, but the next core PCE reading on a 12-month basis is going to be probably 2.7%. So inflation isn't all the way there, but labor markets are loose enough. I think inflation is coming down, but there's still narrow perils on either side of reinflation and recession, but a broad path to a soft landing in between those.
Politics, one of the big risks, at least according to Yardeni, who is just on with us. You wrote this terrific op-ed in the Wall Street Journal, terrific writing. I want to start with just the lead sentence. The first modern presidential race between two candidates with undergraduate degrees in economics hasn't thrilled economists. Why not, Jason?
You know, campaigns are never the place where you're going to completely thrill economists. But, I think an awful lot is the voters want to hear incredibly simple solutions to things. Price gouging, stop Japanese investment in U.S. steel mills, whole new areas that aren't taxed like tips. And, none of these are ones that any economist would recommend. But, there's just quite a lot of pandering out there.
Well, but at this point, some people would say we always get this to some degree, right? I mean, we get pandering, we get promises that don't get fulfilled. You've been in the political sphere before. How different is this time?
It feels a bit different. Look, there's, by the way, things I like in these campaigns, too, especially an awful lot I like in the Harris campaign. So I don't want to say it's all negative. It feels like more because there's more things around limiting trade and controlling prices, a certain type of government intervention, as opposed to the standard, promising lots of tax cuts or spending increases is more the normal thing. This feels to me, more interventionist, more getting in the way of markets, right after they've actually been really quite successful.
And Jason, aren't they both doing this? I mean, Kamala Harris is talking about price gouging on the federal level, and then you have Donald Trump over the weekend talking about capping credit card interest rates. Aren't these both proposals price controls in the U.S. economy?
Yeah, I mean, Donald Trump doesn't seem to be the type of person that respects free markets, competition, and all the things that go into it. He believes very much in a strong government. When he was president the first time, he tried to direct investment this way and that. So yeah, I don't think he's a particularly free market guy.
Can you give us a sense of how you view, if Donald Trump's not a free market guy, who is Kamala Harris?
You know, I'm looking forward to that speech this week. I think we'll hear more about how she defines herself economically. To a first approximation, you can expect a continuation of the types of policies we saw in the Biden administration. But remember, a very, very different context. I thought the initial stimulus was too large, but that's not going to repeat itself. We're not going to have, hopefully, knock on wood, another massive global pandemic that will create the conditions for something like that. So, you know, there have been some whispers about being more pro-business. She spent more time with CEOs than President Biden did. You know, pro-business has its pros and cons, but on balance, I think wouldn't be a bad direction to move just a little bit in the way of right now.
How different would we see a Kamala Harris as a president if we get a sweep versus gridlock in Washington?
You know, I'm not sure about the whole theory that gridlock is the most fiscally responsible outcome here. You know, with gridlock, you're going to be able to extend an awful lot of the tax cuts. It's going to make it hard to enact deficit reduction. And in the past, you've seen the parties make deals where one party gets extra defense spending in exchange for the other getting non-defense spending. So the whole gridlock is good for the deficit thesis. I'm really not sure I believe. If you had a certain number of Democrats there, there's taxes you could raise that you couldn't raise in divided government, and that might result in, you know, a lower deficit than you'd otherwise have.
Jason, I want to finish where we began. You began by saying that economists don't like the kind of tariffs that either side are proposing, the kind of limits to trade that we're seeing proposed. And yet we've seen increasing threats to the supply chain. We've seen increasing questions about, you know, national security issues raised by certain fissures, the breakdowns that we've seen. If we do get some of these gates, some of these tariffs, which both sides are proposing, does that increase the risk of inflation or reignition of inflation in a really material way next year?
Yeah, look, on tariffs, there's a massive difference between these two candidates. Donald Trump is calling for 10 to 20% tariffs on everything coming into the United States. That's stuff that we're just not going to be making here, like ballpoint pens. That's stuff coming from countries that are close allies, like Australia. There's just no coherent theory around that, and it's just at a scale that dwarfs anything that you've seen done in the Biden administration, or I think plausibly would be done in the Harris administration. So absolutely, you follow through on the Trump tariffs, you're going to get a burst of inflation and a real quandary for the Fed, because it'll both lower economic growth and raise inflation at the same time.
Jason, we've got to leave it there. We'll continue that conversation on the Fed and the prospect maybe of rethinking rate cuts with rate hikes in 2025, if that is the direction of travel. Jason Furman there at the Harvard Kennedy School on the latest. Should we talk about tariffs?
Yeah.
I remember hearing exactly the same thing about the Trump tariffs going into the 2016 election. 2017, 2018, exactly the same criticism, and they kept them. So I've got no idea if it's going to be too different this time around. I understand it's a very different policy, but will they keep them if Trump gets another term and does exactly what he says he's going to do?
Well, both of these individuals like the idea of tariffs. It just feels like Trump likes them even more. He's the self-proclaimed tariff man. My question is this a blanket day one, 10% ring around the United States, 60% when it comes to China, or is it what Scott Bessent told us, which is 2.5% on China for 24 months? Xi Jinping, tell us when it starts to hurt. Is this a negotiating tactic, or is it going to be full throttle tariffs within 24 hours of getting the White House?
As for the deficit, I think at this point it's just what is the least worst outcome for the deficit, because there is seemingly no appetite to dealing with it at all.
We have some auctions this week. $69 billion of 2-year notes tomorrow, $70 billion of 5-year notes on Wednesday, and $44 billion of 7-year notes on Thursday.
Looking forward to that. We'll get the results and a traffic update from Lisa throughout the week. From New York City, this is Bloomberg. This just published in the last 24 hours from Stuart Kaiser over at Citi. The September event obstacle course did not offer true clarity on growth, the election or Fed policy. As a result, event risk gets rolled forward another month with payrolls the belle of the ball. Payrolls 2 Fridays away. Equity futures on the S&P 500 right now up by 0.1%. On the Nasdaq up by a little more than that. On the Russell up by 1/3. In the bond market, the 2-year up by not even a basis point through last week. 357.61 going into a sprinkle of data, a ton of Fed speak. And a few auctions this week too.
Yeah, I'm watching the auctions, of course. I don't know how many other people are. I'm curious about the 7-year note in particular. At a time where we don't really have a sense of what the bigger risk is, the idea of whether we do get some sort of market deterioration in the economy or whether we get a sort of leveling out inflation right here. I will say, a big question for this market, are stocks less interest rate sensitive than they have been in the past? In other words, are bonds moving to their own tune, to their own music, rather than stocks?
Well, the long end is moving to a different tune than the front end. The 10-year right now, I think, is advancing for a 5th consecutive day of yields climbing on a 10-year yield. The 2-year, 10-year, the difference between the two, the most positive going back to early June 2022. That curve steepening continues this morning.
And I guess is that good or bad, right? And a lot of people will say that typically when it disinverts after a period of inversion, that typically signals recession. This time around, people are saying this time is different, and then they huddle in a closet feeling anxious because you never want to say those words.
In a closet with tin hats, looking at Europe, disinversion of the German yield curve.
That was good.
Thanks. 2-year still rallying, euro weaker, euro dollar 111.22. The single currency getting beat up a little bit, recovering somewhat following weaker than expected PMI data across the continent.
This is what it looks like. The euro area's September manufacturing PMI fell to 44.8 versus 45.8. The September manufacturing data in Germany to about 40. Just this is full contractionary kind of levels that go to the lowest since we've seen going back to the end of last year. How does the ECB continue to hold the line that they're not going to cut more steeply than the Federal Reserve facing an economic environment like that?
Euro dollar 111.21. We're down 0.4% on that currency pair. Under surveillance this morning, Israel stepping up airstrikes against Hezbollah in southern Lebanon. IDF forces striking multiple targets as civilians are urged to move out of the area.
Well, John, when it comes to this, Lisa, I think, hit the nail on the head earlier. This feels like it is already an all-out war, just not in name only. Over the weekend, Admiral Kirby was talking about how they are telling the Israelis there are, quote, better ways to ensure Israeli citizens could return to evacuate homes in the north than a war, than an escalation, than opening up a second front. But that escalation is already at their doorstep.
I mean, look, they're already lobbing missiles. I think there was something like 8,800 missiles that Hezbollah has already launched at Israel since October 8th. You have ongoing strikes by Israel on Hezbollah, not to mention the walkie-talkies and the beepers and some of the other explosions that we've seen. Question here is, what does escalation look like? I think we're not asking the right question by saying, will there be escalation? It's how far will it go?
We keep asking, when does the war start? I think you said it a little bit earlier. What else do you call this?
Yeah.
Right now?
I mean, this tit for tat, we're seeing buildings exploding. Honestly, at a certain point, I think the bigger question is this the modern warfare? How much are people taking some cues from supply chain disruptions, from certain types of strategic blowing up of arsenals? There are lots of things that people are looking at. This is modern warfare, but this is very much a war.
Well, this is prospect of another war in the Middle East. Let's talk about a real war taking place right now. Ukrainian President Volodymyr Zelensky kicking off his week-long U.S. visit in Pennsylvania, stopping at an ammunition plant. Zelensky set to address the UN General Assembly Wednesday and will also meet with Biden, Harris and Trump this week.
Well, he can't afford to play favorites, Kenny, which is why he's going to be meeting with individuals on both sides of the aisle, especially when it comes to former President Donald Trump. I sat down with Zelensky over the summer, and it was very clear to me he really wanted to get in a room with the former president, who was saying that he has a plan for Ukraine. If you have a plan, we want to see it. Zelensky is coming to America with this victory plan that he's going to show both sides. What struck me is the first stop, Pennsylvania. 160,000 Ukrainians live in Pennsylvania. It's the biggest population in the United States outside for Ukrainians. It's also the swingiest of the swing states.
Can we just talk about the use of long-range missiles? How controversial would it be for that to be approved ahead of an election that could change the course of all of this in November?
Potentially it's controversial. The United States has been dragging its feet for it. Biden a number of times has said we cannot allow Ukraine to be able to have the ability to hit, say, something as far as the Kremlin. But the Ukrainians will come back to me and say, we're not trying to hit the Kremlin. What we're trying to hit are Russian bases with jets that they're about to launch at Ukraine and hit strikes like they recently did in the summer that Children's Hospital in Kyiv. So this is a big debate, and potentially we'll get more clarity after the UN General Assembly.
Yeah, one to watch this week, that's for sure. I want to squeeze in this story. Bloomberg learning that Apollo Global Management is offering to make a multi-billion-dollar investment in Intel. This coming days after sources said Qualcomm is floating a friendly takeover of the chip maker. Intel up this morning, Lisa, by close to 4%.
And a lot of sort of post-mortems on how Intel lost the mantle as the darling of the U.S. government and of U.S. hopes to create a foundry that could potentially rival TSMC or at least provide some sort of offset. We really have been talking a lot about whether regulators are going to be more amenable to this, to create a sort of just offset in terms of a chip supplier in the United States domestically, and whether that actually they prefer a Qualcomm takeover, even though they rejected the Broadcom tie-up, or whether they prefer an Apollo investment. Either way, seems like there are investments to be had.
At this point, you've just got to prefer success, right? I don't think Taiwan's worried about TSMC having too much power, are they? I think we just need success in the United States of America.
Especially given the concerns around some of the strategic challenges that should arise if there is a conflagration in certain areas.
Good point. Vijay, Rakesh, Mizuho, 8:15 Eastern Time. Look out for that. The latest in the banking world, some news for you. At a time when many people are doing their banking online, Bank of America is announcing plans to open more than 165 financial centers across 63 markets by the end of 2026. I'm pleased to say that joining us now is Aron Levine, the co-head of Bank of America Consumer Banking. Aron, welcome to the program, sir. I know this is an effort that started about a decade ago. Can we just start there? Just step back and think about the last 10 years or so. How does this move by you and the team align with the evolution of client behavior over the last decade?
Yeah, well, first, thank you for having me on. It's great to be here. Well, you're right. About 10 years ago, we started to expand. And I think the key to think about is what is a financial center used for now as opposed to maybe historically. Historically, financial centers or banking centers were always used for transactions, depositing checks, moving money, paying bills. All of those types of transactional elements have moved onto digital platforms, onto even using ATMs. So what we said 10 years ago is the key for us is how do we provide advice and guidance? How does a financial center become a place where clients come to talk about their life priorities, to talk about what's important, their financial goals? And we have 26,000 professionals, banking professionals, financial advisors, lending specialists, small business bankers, sitting in our financial centers working with the clients. So what is happening is the reason why we keep expanding and growing our financial center footprint is because it's moved from a transactional type of a model to a relationship model, and it's been incredibly successful for us over these last 10 years.
Aron, you've told me a decade, 2 decades ago that eventually in 2024, 95% of client interactions taking place were on the digital platform. I would have assumed that your physical footprint would be getting smaller. Are you saying it's just going to get different? It's just going to change and ultimately it won't reduce?
Well, great point. Well, the fact is it has reduced. So, right, with those transactions moving to digital, we have reduced our footprint. If you go back to 2010, we had 6,100 financial centers around the country. Now we have about 3,800. So pretty big reduction. But at the same time, it has completely transformed. So we had now 10 million appointments were made this year alone for people to come in and talk about advice and guidance. So the idea now is financial centers have, for us at least, have hit kind of that equilibrium where there's opportunity for expansion. We certainly keep optimizing the footprint in any given market, but it's the whole purpose of why people come in now is very different. They're coming in, they open up accounts, but they're really talking about how to make their financial lives better versus how to do a transaction. And that's the real shift that we led about starting 10 years ago.
Financial therapy. It's sort of this question about online. There were a lot of things about, you could plan things online in terms of asset allocation, but it seems like it needs to be done in person. Is that right?
Yeah, well, there's a couple things that our clients still like to do in person. 80% of all new checking accounts is opened in a financial center. And what's funny is if you talk to students around the country, and we have a big practice of working with college students and even high school students, many of them will say, I might not even visit the center, but I really want to know it's there. I want to know if I have an issue, there is someone to go talk to in person. So that's a really important component. But to your point is, what really people are coming in for is saying, I've got all these different priorities. I want to save for retirement. I'm thinking about how do I save for healthcare? How do I save for my child's education? And those are the kinds of questions they want to talk to someone in person as opposed to necessarily doing the research that they can do online.
How much is this really direct competition with some of the local banks, especially given some of the meltdown that we saw in the regional banks?
Yeah, I mean, we've had this strategy, again, and a real belief for over a decade on this idea of high tech, high touch. So we made major investments in the digital space, things like Erica, things like Zelle, Merrill Edge, our online brokerage platform, all of these big digital investments. But simultaneously, we've always felt that it was critical to keep the in-person component and to transform the centers into a place for advice and guidance. So it's been our strategy. We've been executing the strategy. You've seen our growth over the last 10 years as a result. And most importantly, it's about client experience. You know, we have driven our clients' experience scores to all-time record highs. And that's what this is all about. It's giving our clients a great experience.
When it comes to client experience, how much do clients enjoy the robo-advisors that I know you've done a lot of work with?
Yeah, we're really proud. As part of our Merrill Edge platform, you know, we have a self-directed platform and we built a digital advice model. And it's been a really fast-growing component of our business. You know, what's great is we have the ability for someone to still talk to what we call a financial solution advisor who sits in a financial center, but use the technology to identify their risk and sort of time frame, think about how they want to invest across a set of diverse portfolios, all of which that are created by our chief investment office. So it's lower cost, it leverages digital, but it also has the in-person component. And it's been one of the fastest growing components of our business for the last 5 years.
Aaron, do you have a breakdown of what interaction looks like across income cohorts, across age groups as well?
Yeah, sorry, interactions. Yeah, I think what's great about the Merrill Edge platform is it's really made available for anyone at any income level. You know, minimum to start in a Merrill guided account is $1,000. We have investment clients who are really the entire gamut, from someone who's just starting to invest and try to save a little bit of money for maybe their education, all the way up to people with hundreds of millions of dollars that are using our self-directed platform. We also have very close relationships with Merrill Lynch and the private bank. So for those clients who may use some of their portfolio on a self-directed basis, but still want true advice, we work with our advised parts of our company, Merrill and the private bank, to make sure those clients get what they need from a more robust full-service model.
Aaron, wonderful to catch up, as always. Come back soon and we'll continue the conversation. Yeah. Thank you, sir. Aaron Levine there of Bank of America on the latest push. If you'd said this to us maybe 10, 20 years ago, 95% of interactions on the digital platform, I think we'd be talking about a much, much smaller physical presence. And to Aaron's point, it's got much smaller, but the effort, the emphasis has shifted as well. The way you use this physical platform now is very different to what it was used for 20 years back.
You know, it is financial therapy. And you think about the emotional, and you can laugh, but the truth is people have a very emotional response when it comes to money and where they put it, especially after the financial crisis. Think of all those people who grew up having put their savings in the stock market because they were supposed to, because that's what everyone said. And then they lost half of it in 2008. Sure. It changes people's perceptions, and it sort of raises this question, how do you pry the cash out of their hands?
You provided therapy this morning.
And traffic.
Right?
And traffic and auctions.
Therapy, auctions. Isn't it usually fear that you sell?
Well, it's you've got to sort of start with the fear, recognize it, and go to therapy.
And then they go to Bank of America for therapy.
Then you decide,
that's how
take your cash and put it into assets.
All right. Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Citigroup's plans to expand in China have hit a roadblock after the Federal Reserve imposed a penalty on the bank for its data management and risk controls, according to people familiar. Now, Citi is facing delays since Chinese authorities require a clearance letter from the Fed verifying its regulatory standing. Sources tell Bloomberg Citigroup is continuing its discussions with China's securities regulator to set up the business and has no plans to pull its application. Meanwhile, at the box office, Beetlejuice beat newcomer Transformers 1 this weekend. The horror comedy has taken the top spot for the last 3 weekends, taking in $26 million, according to Variety. Demi Moore's body horror satire, The Substance, took 6 plays in its opening, earning the actress positive reviews and some Oscar buzz. And the Chicago White Sox making baseball history this weekend, but not in a good way. The team losing to the San Diego Padres to tie the post-1900 Major League record of 120 losses that was set by the 1962 expansion New York Mets. As for the present-day Mets, they're looking to lock in their place in the postseason with a major series against the Atlanta Braves starting on Tuesday. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Just a little bit of a check on the market for you. Equity futures on the S&P 500 firmer by 0.1%. In the FX market, the euro down to 111.24. The data out of Europe, not great. We'll talk about the other side of the trade up next with Erik Nelson of Wells Fargo. Stocks just a little bit firmer, up 0.1% on the S&P 500. If you check out the FX market, the euro weaker this morning against the dollar. Euro dollar 111.22. Here's the latest. The dollar facing an uncertain future ahead of the presidential election. Erik Nelson of Wells Fargo saying this: under a Harris win with divided control of Congress, we expect the mix of reduced uncertainty and tighter fiscal policy to increase the room for Fed rate cuts, implying an earlier shift to a weaker dollar. Erik Nelson joins us for more. Erik, good morning and welcome back to New York City, sir. It's good to see you.
Nice to be here.
Let's talk about the politics. When can we start trading the politics? Do we need to wait another month?
As soon as there's any sign of one candidate breaking away, right? This is as neck and neck as it gets. So, look, we probably don't have any more debates coming up, so it's a matter of will that post-debate momentum actually start to show up for Harris? We haven't really seen that yet. And until then, we're just trading the macro.
In the meantime, it feels like the Federal Reserve's rate cutting cycle is quite well priced. I won't say fully priced because we don't know how it's going to evolve over the next 18 months, but let's just say quite well priced. And the focus seems to be shifting to the European economic data, where the data has been dreadful. And yet the euro, over the last 2 months, I would say, in the face of a lot of that bad data, has been quite resilient. Is now the time for a catch down for the euro to the economic reality?
We do think so, yeah. And even for the October meeting, we're looking at 10, 11 basis points priced. There's still more room for that to adjust if they actually move. And then, further out the curve, the market's pricing in the ECB going back to neutral, just as they are for the Fed. I think the economic data out of Europe look a little bit weaker, though, than the U.S. The details of that PMI this morning were just terrible. So I think there is some room for catch down here.
A little bit weaker? It seems like it's a lot weaker. I'm just wondering how much of a catch down we're talking about, considering the fact that people are trading off interest rate differentials when the growth differentials seem to only be widening out.
Yeah, and I think what's challenging here is Germany is clearly the weak point, right? The rest of the Eurozone is softening, but not nearly as weak as Germany. I'd say France even, it looks weaker than it was last month. There's some Olympics noise there, but Germany's the focal point here. My question is, when will the German hawks on the ECB start to adjust to this? I'm not sure when that breaking point will be, but October could be that point. We still have some data, bank lending survey, next few weeks. Until that point, it's hard for the market to price in much more ECB easing until we hear the tone shift.
What's neutral for the ECB versus the Fed? Is it a lower neutral than in the U.S.?
Absolutely. Yeah, nominal probably closer to 2, 1.5, 2, something like that.
So why wouldn't the euro trade to that? If that's the ultimate destination, why wouldn't you automatically assume you're going to have a lower rate at the end of the cycle, whenever it may be?
Yeah, so I think the market's pricing in a decent gap now between where Fed and ECB are going to end up in a terminal rate. Let's say it's 80 to 100 basis points of gap. I think that's, look, you look at the longer term chart of euro dollar, right? We've come up from 95, but we're still pretty low. As a test as a European traveler, it's still pretty cheap to go there, right? So
where do you recommend? No kidding.
Where to start? So look, I think the growth differentials, when we see really stark differences, you look at, say, 2015 and 16, right? We had the catch down to China and then the bounce in 2017. Those are big differentials. I think we're moving in that direction, but I think people haven't really been able to make up a clear decision on, is this a recession for Eurozone, right? It's an inflexible labor market, and so it takes time for that to show up.
China and the exposure to China is much greater in Europe than it is in the United States. And right now, China is exporting disinflation. And if we were to have the more relevant conversation, I think, which is the one you alluded to, which is which central bank is more likely to need to go into accommodative territory, at the moment, you'd have to make the argument that that's Europe, right? And not the United States. And that doesn't feel priced at all.
And it's always a question with the ECB of what should they do versus what will they do, right? And this is something we certainly as FX strategists, economists, a trap we can fall into. This ECB feels a little bit different, certainly than the Trichet ECB, where they were hiking in 08 and 11. And I think that gives me a little bit of comfort that they'll be more proactive. Listen to Schnabel. Schnabel, to me, is the one to listen to. Her speeches, they've gotten more dovish in recent months. And I think that there is a realization here that demand is becoming a problem. They're talking about services inflation, but I think that moment will come later in the year.
You make the point, when will the German hawks adjust on the ECB? Are the Germans like the ones that are hurting themselves? The vicious cycle?
Well, I think it's on the monetary side, but I think fiscal side is really where they're having trouble, right? And part of that is you're looking at a coalition government. They don't have a ton of support. They're kind of fractured in terms of, Lindner versus Schultz. There's not a real clear message coming from these people. So, and frankly, they've, of course, faced a very difficult decision earlier in the year from the Constitutional Court in Germany. They can't do a lot on the fiscal side. They're actually tightening the budget because they have to. So not only is monetary too tight, but fiscal is actually getting tighter.
How much harder is it going to be for Germany if we get a former President Donald Trump in the White House?
A lot harder. Yeah. And I think people underestimate how much worse this can get before it gets better. Right? It's not as if, as soon as Trump comes in and there's a threat to the European region, there'll be some massive breakthrough on the fiscal side for the EU at large, right? Germany's, like I mentioned, the politics are challenging there. There is an election next year. Maybe there's some hope for a centrist, kind of stronger, Merz to come in. But he's going to have a difficult time if he wins putting together a coalition government that wants to do big spending, right? There's a lot of hurdles here. So I think it can get worse before it gets better.
Is the former President Donald Trump dollar positive?
I think at least initially. I mean, the tariffs and the trade is, if you look at one thing that man has been consistent on for decades, trade and tariffs, right? And he still has Lighthizer in his circle, and we know he is the architect of all of this. So that's probably going to come through. Whether there's going to be policy around, trying to weaken the dollar, we heard this kind of noise back in 2017 and 18, right? You go back to there's headlines about the Mar-a-Lago Accord, the New Plaza Accord. I'm not sure this is really going to be something that's going to be policy, and I'm not even sure how they would achieve a weaker dollar. So I think the trade and tariffs is what you focus on. That's dollar positive.
So what kind of levels are you thinking about now? Just frame the range for us going into next year.
Well, I think if we see Mr. Trump come back in and you see really the European economy continue to fall over, I think 106, 107 is in play. I think parity is probably out of reach, barring the absolute worst case scenario for everything. But I think if you see Harris win, you can see things stabilize closer to 108, 109 and start to see it turn higher again. Just from, I think that the U.S. fiscal consolidation and the lack of trade and tariff risk coming through.
So Trump is a stronger dollar. Harris is a weaker dollar in your view. What's gridlock?
Well, I think if you look at something like dollar yen, that's where it really shows up, right? Because the baseline here, if you don't have any congressional action over the next 2 years, is fiscal tightening. Right? Okay, we're not going back to a 2 or 3% deficit. From 7 to 8 to 6 to 5, that's a meaningful swing, right? And so I think you see dollar yen really start to participate in that next move lower as rates, really start to adjust lower. Fiscal concerns don't go away, but they abate.
You're here from London. Is there going to be another Liz Truss moment somewhere else? And we talk about this because everyone talks about the deficit and when that could actually affect the U.S. in some sort of dramatic event. Do you foresee that? Do you talk to clients about that? Do they ask you that?
Sure, yeah. I mean, look at France just in the past couple of days, right? We're seeing but I mean, I think it's important to separate. We all want to kind of think about sort of benchmark to recent events. And I think the Liz Truss moment was very much more about financial kind of linkages and the LDI issues as much as it was the fiscal, right? That was the spark, but really the kindling was already there. So I think with something like France or even the U.S., without that LDI kind of component, it's hard to see a sudden 200 basis point move in yields. But look, fiscal concerns are real. We talk to clients about this all the time, and they're not going away, right? Even in the U.S., if you go from 7 to 5, I don't think we're going back to the balanced budget era of the 90s anytime soon, right? So I think it's going to be a concern for a while.
Is it 2 years since Truss?
Exactly 2 years.
Where's 2 years gone?
It's the anniversary of Lisa's favorite moment in financial markets.
Flown by.
Look at you. We're halfway through 2020.
We need another
Where'd that go?
I
know. It's just very much a theme this morning. I will say, though, yes, it does feel like it was just yesterday, in part because it was the first time we've ever seen fiscal actually matter in such a dramatic fashion after so many warnings. And I think it was refreshing to some vigilantes.
The Starmer government communicates like it was just yesterday. I'm not sure how misplaced That is. Erik Nelson of Wells Fargo. You can save that opinion for another day. Coming up on this programme, Liz Young-Thomas of SoFi, Vijay Rakesh of Mizuho, Pooja Sriram of Barclays and Bob Elliott of Unlimited. Look out for that in just a moment. Equity futures on the S&P 500 still just about positive by 0.1%. In the bond market, 10-year yields climbing for a 5th consecutive session. We're up a single basis point.
Market wanted 50, it got 50. I think the key now is, can yield stabilize?
Overall, the economy is performing like it doesn't really get impacted by kind of these swings in rates we've had the last couple of years.
The Fed's trying to get to neutral. It's just it doesn't know where neutral is.
The idea that the Fed simply through its actions brought down inflation, this is nonsense.
I do think that we are headed for a soft landing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Paul Donovan, UBS, love him. Just one of the very best. Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the opening bell. Your scores look like this on the S&P 500. Equity futures pushing just a little bit higher by a basis point or 0.1%. On the Nasdaq right now, we're up 0.2%. On the Russell, the small caps up by 0.4%. Speaking of basis points, up for a 5th consecutive session on a 10-year yield. Lisa, once again, that curve is a little bit steeper in America.
Introducing just a little bit of fear that maybe inflation isn't as dead as some people had proclaimed it. But little fear is sort of the operative word here. We're seeing that in gold as well. Key question here is, given that the data is very much in the driving seat, will it point to a greater risk of a downturn? Will it point to the soft landing that's widely priced into markets? Or does it point to that concern that some people have been raising increasingly about just a little bit of a tick up in inflation?
So let's turn to the Fed speak and let's get to the calendar. There's a lot of Fed speak over the next week. You're going to hear from basically everyone. Pretty much everybody, including Raphael Bostic of the Atlanta Fed, who says a 50 basis point cut does not lock in the cadence of future moves, echoing what we heard from Chairman Powell in the news conference just last week. Others suggesting that maybe they're ready to go another 50.
Neil Kashkari coming out today in an essay where he said he does see a case to be made for an additional 0.5% rate cut this year, talking about how the balance of risks has shifted away from higher inflation and toward the risk of a further weakening of the labor market. This sort of goes and underscores the concern that we hear on the Fed that seems to outweigh what we're hearing with economists who seem to say that the U.S. seems to be chugging along.
Stuart Kaiser was absolutely correct. The question still remains. No question was answered. Now it feels like we're going into the next Fed decision, which is after the U.S. election, with the same question, 25 or 50. And we're not getting an answer right now. But you mentioned Paul Donovan of UBS. He says markets want to hear that the Fed is scrambling to catch up with falling inflation, not that there's anything wrong with the economy.
You'll remember that Governor Mickey Bowman dissented this decision last week. She said going into the weekend, the committee's larger policy action could be interpreted as a premature declaration of victory on our price stability mandate. It's pretty obvious what her concerns are.
Which is the reason why she dissented. Some people would say it was a carefully orchestrated dissent in order to create this feeling that this isn't necessarily going to support 50 basis points in tandem in consecutive meetings. Pooja Sriram coming up later this hour, talking about the cost of this insurance policy. I think it's a really important point, and it goes to communication. The idea that this was sort of a toss-up going into this meeting until a series of articles, and I know people are thinking you're still harping on that, but it raises this question. Is that the cost? That essentially people are going to be looking to communications to give you a sense of where the committee is going to go, and that is prescriptive and actually determinative and not necessarily just a reporter writing.
Are we data dependent or journalist dependent in the quiet period? Is that what you're asking?
It just raises a question. And that cost of what she calls Fed credibility, and other people have been raising this too.
I totally agree.
It raises a real question that I think is an important one to discuss.
If you are a professional forecaster, I think the last month has made life very, very difficult for you because you were focused on the economic data. A great example was Andrew Honhorst and a team over at Citi who had 50 baked in, looked at the economic data, which seemed to be okay, went back to 25 and they cut 50 anyway. So if you're trying to forecast this stuff, it's much harder to do now.
The economic data didn't materially shift. They say that they're data dependent, But one thing we keep raising is that data dependency has a very difficult meaning when you can interpret the data however you want to. And if they had come out and they had cut rates, or if they came out and they said, look, we made a mistake, which is essentially what he did say, in all fairness. He did say, we should have probably cut in July if we'd had that data in advance. So this was a catch-up. But it just raises this question about how predictable some of the future moves are going to be.
There was a great line out of SocGen in the last few months. They talked about data independence. Never mind the data dependence of the Federal Reserve. They talked about the data independence of the ECB. Why aren't they cutting by more? This data on the PMIs just absolutely awful today. The euro's down by about 1/3% to 111.19. And this is the question you keep hearing on the continent from teams, time and time again, from market participants. Why aren't they cutting by more, given the downturn we're seeing across the continent?
I think you're right to point that out. We can be critical of the Fed in whichever way we'd like to, but the bottom line is people should be pointing the finger at the ECB right now and saying, you're looking at an economy that's contracting in manufacturing at the fastest pace going back to the end of this year and continuing to decline, and it is structural. And they're talking about, well, it could go either way. Again, it's sort of, if the U.S. Federal Reserve was going to do that, can you imagine? You've raised this point.
Yeah, I think we'd be in a much bigger mess than we are. And thank goodness the Federal Reserve is not doing what the ECB is doing right now on that particular issue. Anyway, coming up this hour, we'll catch up with Liz Young-Thomas of SoFi as markets await more economic data. Vijay Rakesh of Mizuho as Qualcomm explores an Intel takeover. And we'll speak to Pooja Sriram of Barclays on the Fed's 50 basis point recalibration and the credibility hit they might have just taken over the past week. We begin this hour with investors awaiting a calendar packed with Fed officials. Liz Young-Thomas of SoFi writing, the tone of this game has changed from pause to cutting, from hot to cooling, from tight to balanced, and from inflation to jobs. That calls for a change in market tone as well. The more defensive parts of the market and the rate-sensitive sectors have won out. And I would expect that trend to continue. Liz joins us now for more. Liz, welcome back to the programme. Let's talk about that very specific trade. As you know, those bond proxies, the utilities, more to the utilities trade than just that, I know, but they've had quite a run year to date. Liz, do you think we need an extension of the bond market rally to support those trades, or is this enough?
I think the bond market rally and the equity market need to happen in tandem, and they need to make sense rationally for what's going on in the economy. So let's just be specific, though, on utilities. Part of what's happened in utilities and the rally that we've seen in utilities is because they started to be looked at as an adjacent trade to the AI theme. So there has been some upside and perhaps some multiple expansion in utilities names due to that. I say that as a warning where if the AI trade loses more steam, or if some of those large cap stocks give up gains, you might see a pause in that utilities rally or a give back in the rally. The reason that I've been pointing out these defensive sectors and the ones that have done well, rate sensitive and defensives, are because in this particular environment where you've got a yield curve that is steepening, you've got a Fed that started cutting, you've got on the precipice of money market rates coming down for investors and the income that we've been used to getting out of risk-free assets likely coming down, not dramatically, but coming down, you're going to see those dividend players, and you should see those dividend players pick up, and you should see investors make rational decisions about where to find income outside of some of those really rate-sensitive money markets, CDs, and maybe even treasuries at some point.
Let's just build on that. As the curve starts to normalize and people start to look every single month at the income they're now receiving in a money market fund and say, OK, it's time to do something, are they deploying that cash out along the curve and taking duration risk, or do you actually think they are going to look to the equity market for that income?
I think both would be a good idea at this juncture, but I want to also be clear, this is not something where we've decided that we've secured a soft landing. So if you decide that you've secured a soft landing, you deploy money in the equity market, but more to riskier and cyclical parts of the market. I don't think that we have decided enough yet that that should be the case. So if you're going to deploy assets right now because you're worried about rates coming down and you've got a lot tied up in a money market or in something that's risk-free and you're worried about the income going away, I think you can spread it among the shorter end of the curve, because I would expect that to continue to come down as this cutting cycle carries on, but you can also put it into parts of the equity market that should do well, at least in the beginning of a cutting cycle, which continue to be things like financials, REITs, utilities, staples, healthcare. Be a little more careful with healthcare in election year, but I still think healthcare and things like medical devices should do well in this environment. It's also worth pointing out the 2s-10s curve today, the last time I checked just a couple minutes ago, is positive by about 17 basis points. That's the biggest positive spread we've had in a very long time. So that's the point I was making in last week's piece about this market environment has changed, and it requires investors to look at their portfolios and make sure that they're positioned for what is now to be a different market environment. That doesn't necessarily mean a bad one, but different from what we've experienced for the last 1.5 to 2 years.
What would you have to see, Liz, to get more excited about the idea of a soft landing, to sort of leverage the wagers a little bit more on that?
Well, look, I think the 50 basis point cut gave us a better chance for a soft landing. So that did encourage me. And I applaud the Fed for going big, especially on that first move. I would need to see for at least the next few months the data cool, but not stop. My concern is that we've hit this point in the economy where we're very balanced right now. Things look good right now. The consumer is still healthy. The labor market is balanced. Inflation readings have come down. Things feel good right now. We are not overheating. But my concern is that we're just making a pit stop in this balanced level on our way to weak. And what we don't want is for that to surprise markets and surprise the Fed. So I don't want people to declare premature victory, premature soft landing at this point. I think we still need to get quite a few more readings, particularly on the labor market. I think the labor market holds the key for the rest of the year.
If the risk is to the downside, Liz, why aren't you recommending that people take their cash and put it into the long end?
Right now, I think there is more volatility on the long end because of this large cut in the beginning and because there is still a gap between what the market expects and what the Fed is saying they're going to do for the remainder of the year. So the market is pricing in 3 more 25 basis point cuts. The Fed is not entirely sure that that's going to be the case. So if we hit a point where inflation starts to heat back up, and it sounds like there are even Fed officials with that concern right now. If inflation starts to heat back up, or if we see a major resurgence in maybe consumer spending, or if we see an uptick in commodity prices, I think the long end of the curve is going to see more volatility.
Let's just build on that, just to finish. The balance of risks around that story. Do you think there's equal amount of risk to a re-acceleration in this economy as there is to a downturn?
Personally, no. I think there's more risk to the downside, particularly in the labor market. And I think at this point, because of how we got to balanced and because of how inflation has come down, first in the goods portion of the economy and then in the services portion, we've still got shelter holding it up. But I don't think there's as much of a risk of an overheating due to demand. So I want to make that distinction very specifically as well. I think that consumers have pulled back enough that even aggressive rate cuts shouldn't fuel an overheating again in the economy that makes demand outstrip supply in some of those categories. Where the risk is on a inflation reheating, I believe, is in the commodity complex. So if you see things like oil come back, if you've got metals that go up somehow dramatically, if there's a global shock, which there's always, of course, a risk of, I think the bigger risk in inflation is really about commodities.
Interesting. Liz, we'll leave it there. Wonderful to catch up as always. Liz Young-Thomas of SoFi, that final note there on the commodity market.
Yeah, although I wonder how difficult it would be to get that resurgence in inflation coming from commodities unless China gets some sort of stimulus package. I mean, this sort of goes to the question of how much could shift after the election is over as people start to make the moves that they've been holding off on.
All roads at the moment in every conversation seems to lead to China. And right now they're exporting disinflation. Bob Elliott of Unlimited is going to join us at 8:30 Eastern time. Look out for that conversation. We'll focus big time on that. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. Congressional leaders unveiled a stopgap funding bill yesterday to keep the U.S. government open through December 20th. Negotiators are working to avoid an October 1st shutdown and set the stage for a funding showdown shortly before Christmas. Lawmakers aim to vote on the measure by Wednesday. Meanwhile, Boeing ousted its defense chief Ted Colbert over the weekend. The move is one of the first major shakeups by CEO Kelly Ortberg, who took over last month. The defense division has been losing billions of dollars in cost overruns and saw negative headlines after NASA decided it was too risky to use Boeing's Starliner space capsule to bring 2 astronauts back from the International Space Station. The company is also dealing with its second week of a strike. And U.S. billionaire Dan Friedkin is closing in on a takeover of Everton FC, according to people familiar. The deal would bring an end to months of uncertainty at the Liverpool-based football team. Friedkin, who also owns the Italian club AS Roma, held exclusive talks before announcing in July that he wouldn't be proceeding with a takeover. Everton is moving to a new 53,000-seat stadium next year, which it hopes will boost revenue. That's your Bloomberg Brief. John?
Yahara, thanks for the update. Thank you. You'll hear more from Yahara again in about 30 minutes. Up next on the programme, the morning calls, plus Vijay Rakesh of Mizuho as Qualcomm floats a friendly takeover deal for Intel. That conversation up next. Live from New York City, your equity market firm by 0.1% on the S&P 500. In the bond market, yields a little bit higher for a 5th consecutive day, 375.65. Gennady Goldberg over at TD. We would look to be buyers on any significant move higher in rates and still expect 10-year yields to finish the year at 350.
To me, this is the big question. At what point do people start more aggressively buying the long end? And if they don't, how surprising is that, given some of the longer-term projections that we're hearing from the Fed themselves?
If you believe there's going to be this great slowdown, if you believe if the Fed's going to be wrong with the dot cut, ultimately it's going to be wrong because they're too high and not too low, then ultimately isn't it a buy?
Well, that's the reason why it's sort of surprising that we haven't seen actually more buying action. And I will just say, $44 billion of 7-year notes coming on Thursday. Watch it.
Watch out. That and the traffic update as well, which I absolutely love from Lisa this morning. The average traffic speed in New York City this week, 3 handle.
In Midtown is 3 miles per hour. But Gridlock Sam says that it does sometimes average 0.
Who's Gridlock Sam?
Gridlock Sam.
On Twitter?
No, Sam Schwartz. He's known as Gridlock Sam.
Never heard
he
of it.
tracks us from the Department of Transportation.
Appreciate the update.
Gridlock Sam, we
Because you
welcome
don't drive in New York. John takes the metro.
Do you drive in
either.
Midtown New York? No. Let's get you some morning calls. First up, D.A. Davidson cutting Microsoft to neutral from buy, saying the company's AI lead has diminished. The stock is down by about 0.5%. Your second call from Bernstein cutting General Motors to market perform from outperform. Data suggesting there might be rising earnings headwinds. That stock is down by 2.8%. And finally, Citi raising its price target on Meta to $645 and keeping a buy rating on the shares. Meta remaining the firm's top pick across the internet sector. That stock is up by 1.2%. Let's stick with tech. Intel in the spotlight. Sources telling us here at Bloomberg that Qualcomm has approached the chip maker about a potential takeover deal. And now Apollo Global Management making its pitch, offering an equity-like investment of as much as $5 billion in Intel. Vijay Rakesh of Mizuho joins us now for more. Vijay, some big changes going into the weekend and coming out of the other side to start this week. Of these offers on the table, if they do evolve and materialize, which one do you think is more attractive to the firm?
Yeah, thanks for having me on, John. So the Qualcomm takeover of Intel, I think it looks like Qualcomm is trying to diversify. It's good for Qualcomm, but the problem is the price tag might be too high to afford. If you look at the sum of parts on Intel between the PC business, the server and data center, AI, etc., it comes to almost $186 billion on a sale price tag at the least, versus Qualcomm market cap about $188 billion. So they have to definitely look for some pretty big financing to make this acquisition. But also, I think if you look at Intel, they have $53 billion of debt and a negative $20 billion free cash flow. So there are some massive challenges in looking at that acquisition. So that's definitely a challenge. But something like a private equity investment is much smaller at $5 billion. It's more palatable, something that Intel is definitely shopping around. And they've had prior investments into the Ireland fab as well. So that looks something that is manageable.
Vijay, the regulators watching on, what do you think they'd prefer to see?
Yeah, I think it's a mixed bag. I think if you look at Intel, it's definitely a national asset, and I think they have been they are the pillars of manufacturing in the U.S. So definitely want to keep it in the U.S. So But for Qualcomm to come in, it could invite FTC scrutiny in terms of having both ARM and x86 and multiple other technologies in-house. But also you could see pushback from peer semiconductor companies as well, similar to what we had in the prior NVIDIA ARM acquisition. And lastly, I would say China, right? I think China MOFCOM, they might need approval out in China as well, given Intel's exposure in China. So there are some challenges on the regulatory side for sure.
What's the benefit for Intel? I mean, why do they need a white knight at a time when not so long ago they were the national champion?
Yeah, I mean, I think if you look at Intel, they had been the manufacturing leader, they had been the technology leader, but over the last 5 years, they've lost their way. I think CEO Pat Gelsinger has focused on the 4 nodes in 5 years, but it has failed to deliver market leadership in PC or servers, meaning they've lost share in PC and servers for the last 5 years to AMD. That's not translated to real market share gain or profitability. Margins are down. Free cash flow is at negative 20 billion. And going on to the foundry side, it's a long-term vision, it's a long-term roadmap. And that even looking out for, out to 2030, they talked about a 15 billion revenue from that on the foundry side. So that's still pretty small compared to what TSM is doing, let's say today, somewhere in the 40 billion plus. So I think they have long ways to go. There are some challenges there. They lost their way on the market side and technology side and the manufacturing side, and so that's where we now end up. So,
when it comes to the regulators, are you saying that it's merger dependent on what basically they'll allow through?
Yeah, I think when you look at Qualcomm itself, they obviously have their financing challenges, as they mentioned, but they might not be as interested on the foundry side because they have a pretty good strategic foundry relationship with TSM. But if they were to look at the other segments, PC, data center, etc., the question is how much consolidation or how much concentration do they allow Qualcomm to have on the PC side or on the server side, and so that could be where the challenge is for Qualcomm from FTC, just a US FTC regulatory standpoint. There could be other global regulatory challenges as well. There could be pushback from other peers as well who want to step in and take some of the assets. So,
Vijay, I'm just curious, which would you put your money on in terms of Apollo versus the potential for a Qualcomm takeover?
Yeah, I think Apollo is a much easier one. I think it's much more manageable, as we mentioned early on. But I think, I think Qualcomm, there are a lot of hoops they need to jump. And so I think that's a little bit more of a challenge. But the Apollo one seems like a much easier one for Intel to do.
How long would it take for U.S. national championship to really compete with TSMC?
Boy, that is a very good question. I think it'll take a long time. I mean, it'll probably take in the neighborhood of 5 to 10 years at the least, because obviously Intel first has to regain its technology leadership. And then they have to prove their technology leadership because I think that's a leadership that's earned. It's not something that is given. And so I think there are some challenges there. They definitely have to get ahead of TSM, but also be price competitive. So there are significant challenges. And TSM obviously is based in Asia. They have access to much cheaper labor and much more qualified labor in many cases as well, versus a much higher cost region in the US for Intel. So there are some challenges there. So we think it could take a little bit of time.
Vijay, just quickly, and I understand this might put you in a compromising position, but have you been surprised there hasn't been a management change at Intel?
I think CEO Pat has his challenges. I think he has been there 3 years plus, and so there is some investor concerns, investor angst around it. The board has definitely stood by him, but I think the continuing challenges definitely pose some concern for management and for and I think I think the investors are definitely in that docket as well. So,
well, thanks for sharing your opinion with us this morning, sir. We appreciate it as always. Vijay Rakesh there of Mizuho on the difficulties and the opportunities that confront Intel this Monday morning.
You ask a really good question, which is how have we gotten here without some bigger wholesale changes, given some of the fallbacks in some of their strategies?
Talk about the difficulties with this firm all the time.
I know.
every single earnings season.
Yeah, and the hopes and dreams for this to really become a real competitor with TSMC.
Pooja Sriram of Barclays up next alongside Bob Elliott of Unlimited. That conversation just around the corner. Max Kettner, HSBC. Take a listen to this line. There could be a non-negligible risk of a growth uptick and threat to the disinflationary progress in the coming quarters. This leaves short-term inflation and terminal rate expectations too low relative to economists' forecasts.
This is the risk case that you're feeling tick up in gold, although some people might say, why are you watching gold, or even the long end of the yield curve? And you start to hear it around the edges. If the economy is as good as it looks now and doesn't turn down, well, what's on the other side of that?
Things right now seem to be okay. Equities are positive by 0.2%. Nothing to see here, Bramo. Gold very close to all-time highs. On the Nasdaq 100, we're up by 0.33%. 1 hour away from the cash open with some morning movers. Let's get across to Manus Cranny. Morning, Manus.
Jonathan, very good morning. Yeah, Max Kettner, when he was here just a week ago, very bullish on US equities. This is how we start the day on Intel. You spent a bit of time on this, but I just want to put this to you, which is one is a potential bid from Qualcomm, which is about taking this asset, taking it apart, and it is a sum of the parts friendly bid. The other is an offer of an equity slug, $5 billion into this company from Apollo, a deal and a company that they know very, very well because they did an $11 billion deal just a few months ago. So one is about potentially taking this company apart. The other one is very much a vote of confidence in the offer of an equity slug. We'll see how it plays out. Let's roll it forward and have a look at GM, never far from our mind. This is Bernstein. They downgrade the stock, Jonathan, this morning to from outperform. Now, what they've said is not only are they downgrading the earnings, there's an inventory build here in the USA, and also they may need capital in the back part of the autumn. Just turn it around in your mind. Mary Barra's had to step back from electric vehicles, from that big banner of a million electric vehicles by 2025. Let's close it off with technology. It's a wraparound. This is one of the biggest nuclear players in the United States of America. They're going to revive a plant in Pennsylvania. They're going to put in $1.5 billion. And what are they going to do with the power? They are going to sell it all to Microsoft on a long-term deal. This is the very personification of hyperscalers and what they need from the energy industry in the United States of America. Jonathan, good morning.
Manus Cranny, thank you, sir. Timely. Energy demands sky high on this front.
And how much do you end up having private adjustments made with specific tech companies trying to contract for their own energy uses to offset that? We've seen that to a little degree over the past few days.
We spoke to Baker Hughes recently as well, talking about off-grid solutions. The stress on the grid, the demands on the grid are going to be absolutely humongous over the next several years off the back of this story.
How do cloud providers ensure that no breakdowns occur for their clients, and how can they ensure that unless they get some of their off-grid solutions like what we've heard about recently?
Let's turn back to the markets. Equity futures right now up 0.25% on the Nasdaq 100. Looking ahead to a busy week of data and Fed speak. Pooja Sriram of Barclays saying the following: even the 50 basis point cut appears to have been a close call. The outcome bears the distinct imprints of a compromise, with hawks trading the 50 basis point cut in favour of hawkish messaging and a relatively high bar for the unemployment rate to warrant another aggressive cut. Pooja joins us now for more. Pooja, I just want to get to your growth outlook, and I just want to sit on your GDP outlook. Did you raise your GDP outlook after getting that surprise move from the Fed last week?
We did. Good morning, first of all. We did raise it by about 0.5 percentage points for the end of Q4. So we're still penciling in 2% growth for the fourth quarter of this year. And then we've got a similar pace of growth, in fact, through the end of next year. Some of that was, of course, the easing in financial conditions that we've seen over the past, couple of weeks. We track the Fed's FCIG measure, which translates financial conditions into the impulse for growth. And it does suggest that growth could look better. So, yes, to your question, we have raised our GDP forecast modestly in the near horizon. Yeah.
How does that line up with your view on the Fed's next move and the moves through 2025?
Yeah, that's a good question. So look, our own baseline is for 225 basis points cuts this year. So that's, broadly in line with the median projection for 2024. For 2025, we've got 325 basis points cuts. So that's a total of 75, as opposed to the 100 basis points cut that the FOMC median has. And that's really predicated on the view that, the economy is going to look pretty decent. We don't have the unemployment rate staying, at 4.4%, which is what the FOMC has. We, in fact, do see it ticking lower. So we do think that, they could afford to slow the pace of rate cuts going into 2025.
Pooja, you wrote something in your recent report that I thought was fascinating. Whatever was gained by the Fed's 50 basis point rate cut may have come at a significant cost. And you go on to say that it seems quite likely that similar Wall Street Journal articles, akin to what we saw ahead of this latest 50 basis point rate cut, during that blackout period coming up, any blackout period, will be interpreted as legitimate signals, leading to unnecessary noise. This cost may well exceed whatever benefit the Fed achieved by front-loading one cut, in our view. Can you just elaborate on how much this adds to potential uncertainty for you?
Yeah, I think that's a great point. So, just to take a step back and to recap what happened, before the Fed went into the blackout period, we had a bunch of data in hand. I think the last print we had was, the non-farm payroll. We heard from FOMC officials, namely, Waller, FOMC member Williams, and the markets were essentially quite content to price in a 25 basis points rate cut. That was our baseline as well. Everything looked good. And then, as you mentioned, we got a bunch of these articles, and suddenly it raised the question and, put the possibility that the Fed could perhaps, go a little more aggressive and go 50 basis points. And then, the pricing moved. And surprisingly, the Fed actually ratified that move in market pricing. And we found that quite surprising, to be honest, because it did not come on the back of data, and in fact came on the back of a bunch of articles. And what this means is if something like, if there's a precedent for this now, it's quite possible that there's going to be a lot of noise and volatility around the blackout period if we get more news information this way. And in terms of the fact that the Fed did not gain much is, the markets are still pricing in about the same amount of rate cuts as they were before the news articles came out. So it's not very clear to us what the Fed achieved by ratifying market expectations going this route.
This might sound like a dumb question, but what is the actual economic cost, though, of a little bit more volatility around the blackout period?
Well, I think it can get markets to run away with expectations. It's you would think that the data, hard data on economic activity, what you're officially hearing from the FOMC guides market expectations. But if you have something like this, it can lead to a lot of volatility. Market pricing could go different ways. And then if the Fed outcome looks very different to how the markets have moved, it can create financial market volatility. So I think that was the point that we were trying to make, that it creates unnecessary noise, especially after an era where Fed communication has been really on point and they've really made an effort to do this so well.
Given this, do you think the Fed now has a credibility problem?
Doesn't seem like it. When we think of monetary policy credibility, we do tend to look at inflation expectations, right? The credibility comes from the fact that how committed are they towards their dual mandate. And right now, there's no question that they're very committed. It does seem like the focus is a little bit more on the labor markets than it is on inflation, as it should be, given the inflation outcomes are pretty good. So I think it's too early to start questioning any of that. But it does create a bit of a kink in the communication policy.
Pooja, we've got to leave it there. Appreciate the catch-up. Pooja Sriram there of Barclays. With us around the table to continue the conversation, Bob Elliott of Unlimited. Bob, good morning and welcome to the programme.
Good morning.
What did we achieve with a 50 basis point rate cut last week at the Federal Reserve?
Well, I think the biggest thing that the Fed highlighted was that they were trying to paint the picture of a strong economy and sufficient disinflation that they can deliver big cuts relatively quickly into that scenario. Now, you can argue whether you actually believe that that's true, but I think the path that they're laying out, they're committed to, and they believe it's data-driven because they believe that the inflation numbers are going to get back to their 2% mandate. And that's very interesting for markets. It might be too easy into a hot economy, which has got a lot of effects, second and third order effects that they might not expect.
Are you a believer?
In disinflation? No, probably not. I think the thing that's interesting, inflation is still running above the Fed's mandate. We have to remember that, no matter how you slice it. And easing into that environment when you have a hot economy means that we're probably more likely to get acceleration rather than deceleration ahead. The thing that's interesting about that is that the Fed probably won't see that data come out until they've cut a few hundred basis points. And only then will they be held accountable for the fact that the disinflation might have reversed. And so I think it's a tricky period over the course of the next, 15, 18 months when the Fed isn't going to get the feedback loop that their policy is too easy.
Just to put a bow on that, are you saying that right now the risk of a reinflationary kind of moment is greater or less priced into a market and more real than, say, a downdraft in growth?
Well, certainly it's less priced into markets. When you look at long-term inflation expectations, the expectation is for inflation to be at 2% or below 2% essentially forever. And given the geopolitical dynamics, given the Fed's easing into a relatively strong economy, given the fact that you still see a lot of sticky dynamics in inflation, particularly related to wages, which are showing some signs of reaccelerating, that whole picture doesn't really align with the probabilities of, a certainty around 2% inflation, and much more likely that we have higher inflation ahead rather than lower inflation.
Normally, somebody with that kind of view would be bullish, because if you believe in this sort of strong economy that could foster some reignition of inflation, that would be probably positive for equity valuations. But you wrote the stock market is priced to perfection. And so far, this quarter is providing plenty of data points that the perfection is unlikely to be achieved in reality. Why?
Well, I think when you're trading markets, you got to trade against what the price and expectations are. And we're at PEs that are, almost as high as they were during the tech boom. We have forward earnings growth expectations in the mid-teens. That's a pretty strong scenario, already priced into the markets. Now, the Fed is helping that along, and that's probably a positive. But I think the story is much more around being long stocks relative to bonds, because that's the scenario, of the growth reacceleration that probably isn't fully priced into the market.
Let's introduce China into the conversation. They're now exporting disinflation, perhaps even deflation. How do they factor into your worldview right now?
Well, China's experiencing debt deleveraging, akin to what happened in Japan and akin to
sort of classic balance sheet recession.
A classic balance sheet recession. And the policymakers there are maybe driven by motivations that are not related to macroeconomic policy, more like political motivations. And so for whatever reason, they're choosing not to respond to the situation. And so China's probably in this malaise for the foreseeable future. I think the effects on the West are actually relatively limited. And the reason why that is China's deflationary impulse has been basically the same for the last couple of years. Probably China is not going to accelerate in terms of getting a deeper and deeper or a worse rate of deflation going on in the economy. And if anything, we've seen it tick up. And so the big picture is it's probably not the main story that's going on. When you're looking at U.S. inflation and Western inflation in general, what really matters, it's the labor markets. It's all about the labor markets. It's all about that wage data. If you look at the Atlanta Fed wage tracker data, we're 1 to 2 points above where we were pre-COVID. And unless you believe productivity has matched that increase, that's an underlying inflationary pressure that remains in the economy.
But Bob, isn't the deflationary pressure coming from China has everything to do with the commodities market? Isn't that helping Western economies?
Yeah, it certainly is an effect on the commodities markets. And if you're trading, copper or other direct commodities that China has a meaningful share of, that's going to be a meaningful influence on that supply demand. But the flow through of that to the U.S. inflation picture, it's pretty tiny compared to rents, labor, the other sort of imported, imported goods costs that, cars, new cars, used cars, all of those things represent a much bigger impact on U.S. inflation and U.S. policy.
Liz Young-Thomas, our guest at the top of the hour, was talking about one risk would be reacceleration of commodity prices. Do you see that where China is right now?
Commodity prices have basically been trading, and particularly oil prices, which is really the thing that matters, have been trading in a tight range over the last couple of years after the move down 18 months ago. I don't see meaningful pressures on the upside or the downside. On the downside, you've got a natural cap in terms of suppliers taking barrels off the market if oil prices start to fall a little too much. And on the upside, there's still a lot of incremental production. U.S. production is near all-time highs. A lot of production that can come into the market to put a cap on it. So that's probably not the big story here. It's much more about the sticky inflationary pressures in the economy on the forward-looking basis.
How much would longer-term yields have to rise to make you a buyer?
Well, I think at this point, you've got to see inflation expectations move up considerably here. So I think, easily into the mid fours before you start to have a real conversation that's an attractive bid, particularly relative to stocks in a stronger growth environment.
When you say inflation expectations, you're talking about markets-based pricing, or you're talking about consumer surveys, the likes we see from you, Mitch, every other Friday? What are you looking for?
Mostly in terms of trading the bond market, it's all about price and break-even inflation. And so that's the thing that if you look at the markets basically priced to be, at 2% or below essentially forever, or inflation swaps, that's what you're trading. And those are the areas of the market that look particularly underpriced. The reality is if you're going to get exposure to duration right now, buy the tips. Right, you're seeing real yields that are still pretty good on any long-term perspective. Around 1.5% to 2%. That's a pretty good real yield if you can lock it in for 20 or 30 years without any risk.
Bob, it's good to see you. Let's do it again soon. Thank you, sir. Bob Elliott there of Unlimited on this bond market. Bramo, your thoughts?
Well, I think that this is an increasing conversation about if you believe this economy is strong, then wouldn't you go into stocks and avoid bonds, longer-term bonds? And you get a flavor of that. Even people like Liz Young-Thomas, who's worried about the downside risk, you have a hesitation of buying the long end. This just raises a real question to me about what kind of drama you could see around the election with respect to the long end. And at what point people do come back and buy it if you start to say, OK, the deficit's going to be there, but, what else is new?
No drama right now. Equities positive by 0.1% on the S&P 500 for a fifth consecutive session. Yields a little bit higher on a 10-year. We're up by 2 basis points. The yield, 376. With an update on stories elsewhere, here's your Bloomberg brief with Yahira Hackers. Hey, Yahira.
Hi, John. Bloomberg has learned that the U.S. Commerce Department is getting ready to reveal proposed rules that would ban Chinese and Russian-made hardware and software for connected vehicles. The announcement could come as early as today. Commerce has been meeting with industry experts in recent months, looking to address security concerns raised by a new generation of so-called smart cars. Meanwhile, the New York Times is reporting that more than 700 current and former national security officials are backing Vice President Kamala Harris. A letter signed by former Secretaries of State and Defense endorsed Kamala Harris and said former President Trump poses a threat to the nation's defense and democratic system. Among the most prominent names were former Defense Secretaries Chuck Hagel, a Republican who served under President Obama, and William Cohen, a Republican who served under Clinton. And the WNBA playoffs are underway with Alyssa Thomas and the Connecticut Sun soundly defeating Caitlin Clark's Indiana Fever 93-69. Thomas posted her fourth career triple-double in the playoffs and 15th overall to spoil Clark's postseason debut. Indiana will look to even the best-of-3 series in Game 2 on Wednesday. Other Game 1 results yesterday include wins by the New York Liberty, Minnesota Lynx, and Las Vegas Aces. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the week ahead, the day ahead, and we'll catch up with Mandeep Singh of Bloomberg Intelligence on the prospect of a big deal in the chip space. We are 40 minutes away from the opening bell. Equity futures just a little bit firmer, up 0.1%. The calendar for the week ahead, your trading diary looks like this. S&P Global Manufacturing PMI coming at 9:45 Eastern. Later on today, more Fed speak from Goolsbee and Kashkari. Tuesday, the UN General Assembly kicking off. Can't wait. Plus, we'll get consumer confidence. Wednesday, Micron reporting earnings after the closing bell. Thursday, we'll get another round of jobless claims. Plus, more results from Costco. And on Friday, PCE and UMich sentiment. The stock to watch going into the opening bell, Intel. Shares are rising in the pre-market following reporting that Qualcomm may be interested in an acquisition, and Apollo now offering to make a multi-billion-dollar investment in the company. That stock is up by 0.8%. To talk about this space and a whole lot more in the world of tech, Mandeep Singh of Bloomberg Intelligence. Mandeep, good morning to you, sir.
Morning.
I want to start with this. Will Wade and Dina Bass here at Bloomberg leading with this quote, this paragraph going into the weekend. The owner of the shuttered 3 Mile Island nuclear plant in Pennsylvania will invest $1.6 billion to revive it, agreeing to sell all the output to Microsoft as the tech titan seeks carbon-free electricity for data centers to power the artificial intelligence boom. Is this the beginning of something much bigger in this country?
I think so. I mean, look, there is a clear demand for, building data centers that can train these large language models at the scale that currently, we are not at. And what they're trying to do is focus on renewable energy. So all these large hyperscalers have goals around using, more renewable energy. And look, that's why they are going down the stack in terms of doing it themselves, because they know exactly the configurations for these data centers that they need, what kind of power requirements they have. And I mean, to me, this is a classic case of vertical integration. Microsoft owning the stack end to end, from power to chips to literally the software they're producing.
Have we had a big enough conversation about the costs associated with the power that's going to be demanded?
Well, so power in the end is still a regulated entity. Look, they have, much bigger power requirements than they had 5 or 10 years back. But in the end, the government is overseeing that. They will get that support, and the government wants Microsoft to build large data centers here because they want to own the data. They want everything to be done onshore. So I think I wouldn't worry too much about the power costs. It's more the chip costs that they have to deal with, and that's why they'll probably go with their own chips at some point.
But to John's point, I understand that they're regulated entities, but if they're going off the grid in order to provide their own electricity, at what point do we have to start to look at the fixed costs that are increasing, that are having to be provided privately by some of these big tech companies in order to provide the reliable service they're promising?
I mean, there's no doubt that, their cost of goods will go up, but it's already gone up. And look, the big bet is that AI will drive productivity. Now, you could argue we are not seeing that productivity now, but in their end product, if they can offer a co-pilot that helps you, become 20%, 30% more productive, then companies or consumers don't mind paying for that. So the big bet is with this AI wave is it's going to drive productivity. And you're going to start seeing that 2 to 3 years down the line. Otherwise, you will see some cancellations in terms of, the CapEx plans or what they intend to do in the long term.
Aren't new data centers on hold because they cannot connect to the grid because they're just too powerful? How much is this going to be basically the source of new deals? You have to get your own basically mini grid in order to operate.
Well, so again, I think, yes, they need that power. They need the large data center setup, and they need big AI clusters. I mean, remember, as long as the large language models keep growing in size and the next GPT-5 version or the Anthropic model is 10 or 15 times bigger, you need more power. And that's where, they will work with all the entities in the chain, whether it's energy companies, whether it's private equity guys. And those are the trends you're seeing right now in terms of, the partnerships that these companies are doing.
You said something about Microsoft and we didn't miss it. They'll develop their own chip. Is that where you would think this is going? And why don't they just buy Intel and just do it through Intel?
Well, so Intel, look, the turnaround of Intel is not very easy. And we have seen that in the last 3 years with Pat Gelsinger at the helm. Nobody is betting on that turnaround. The question is, does Intel have certain pockets that will fit strategically with some other companies? So the PC business is still attractive. It generates $6 to $10 billion in free cash flow. The data center business is losing share to NVIDIA. The foundry business is where it keeps losing money. So maybe Intel is better off, being kind of split in a way where it makes strategic sense. And the foundry business could be useful down the line. But the problem with foundry business is it's losing $20 billion in CapEx. It requires a lot of upfront investment. And nobody has the patience to do that with Intel.
Just quickly, Qualcomm circling, Apollo circling for a cash injection. Are you looking for more names to come into this?
I mean, it will be a buyout. So we're talking about $150 billion plus deal here, and it has to be a consortium. I can't imagine Qualcomm buying everything. If they're buying, they'll sell some assets, to begin with. And that's how I think you could conceive a deal where Qualcomm would want to own certain parts of Intel.
Interesting. Mandeep, appreciate your time. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Intel, the one to watch, going into the cash open. Coming up tomorrow, Brian Levitt of Invesco, Stuart Kaiser of Citi, Emily Rowland of John Hancock, and Jill Carey Hall of Bank of America, all welcome in the studio if they can make it through Midtown Manhattan. From New York, have a fantastic week. This was Bloomberg Surveillance.